Welcome to Yahoo Finance's special coverage of the November CPI report. I'm Shauna Smith alongside Brad Smith. The key inflation print crossing the wires as we speak. The month-over-month CPI number coming in line with expectations, a rise of 0.3%. The core reading, when you take a look at that month-over-month movement, it also coming in line with expectations, also steady from the prior reading of a rise of 0.3%. Brad, when you take a look at the headline number here, CPI on a year-over-year basis rising 2.7%, a bit quicker. That was in line with expectations, a bit of an uptick there from what we saw in the prior reading of 2.6%. The core year-over-year change also coming in, rising 3.3%. That was also in line with expectations. So again, when you take a look at the markets, at least initial reaction to this, it looks like we are extending some of the gains that we were seeing here ahead of the open, although not too much movement here right now. But you are looking at futures still on track to open the day in positive territory, at least for right now. Obviously, all of this could change. But again, very much I think you could categorize this as an inline report with many of these headline numbers coming in line with what economists had forecast.
Yeah, perhaps people are waking up this morning, getting that first cup of coffee, or if you're in our newsroom, your second cup of coffee at this juncture, and looking at some of the indexes within this and wondering just what's driving this right now continuously. Shelter, that's your answer right now. That accounted for nearly 40% of the monthly all items increase. Looking at some of the other indexes, though, to see where we did see some increases versus decreases here, there were few indexes that did decrease over the month. Communication services or communication was one of the few major indexes that did decrease during the month. However, taking a look at the indexes that increased, we mentioned shelter, but also used cars and trucks, household furnishings and operations, medical care, and new vehicles and recreation, those among the most increases that we've seen over the month of November. So that just a little bit of a brief dive into some of the indexes that we're tracking. And taking a look at the futures here this morning, we're still seeing gains as of right now for the Dow Jones Industrial Average, the S&P 500, and the NASDAQ futures, all fractionally higher as of right now.
All right, let's bring in our panel here in studio to break it down, this print. We want to bring in Marvin Lowe. He's a senior global macro strategist at State Street. We also have Gregory Dacco, a chief economist over at EY. Guys, Greg, I'll go to you first, just in terms of how you think this plays into the Fed factor next week. When you take a look at this print, clearly we did see a bit of an acceleration when you compare that month-over-month reading to what we saw last week, but very much in line with these expectations.
Well, I think there's a bit of good news and a little bit of bad news. The good news is that we have an environment in which we're not seeing any acceleration in inflation. If you look at the core print, 0.3% in line with expectations, in line with the last few months. Yes, it is a little bit hotter than the Fed would desire, but you're seeing that inflation on a year-over-year basis is still moving closer to the 2% target. So that is encouraging. The bad news is that there is indeed some stickiness in the underlying inflation dynamics. You're seeing core goods prices rising. This is something that we have to be a little bit careful of, especially as we look out on the horizon with the potential for tariffs that could be inflationary. Overall, though, shelter cost inflating a little bit less than expected. That's an encouraging sign as we're seeing housing price inflation start to moderate and help with the inflation dynamics overall.
Marvin, I mean, just easily, as you're thinking about the first trade that you would be thinking about, or if this just further settles you into your existing positioning coming off of a print like this, what comes to mind?
Yeah, I mean, I think the fact that it's consensus means the market's going to get comfortable with it. So we'll firm up what's already a pretty firm expectation for the Fed next week. Market was pricing over 80% that they're going to cut. Everything that we've heard up until now is that, they're looking at the disinflationary trends, not necessarily the numbers. I do look at the numbers, however. Spot 3 month over month is nowhere near what they need to see in order to get to 2%. We're seeing a lot of the stickiness that you talked about. And, for sure, the market is really questioning whether or not the Fed can get to that 2% number. Market pricing at this point is that we're pretty much done with this cutting cycle after the next 4 cuts. That's much more aggressive, at least on the upside from a yield perspective, than what the Fed had said just 3 months ago. Every 3 months, it seems they change their mind, so we'll see how they change their mind after the September to December kind of time period. But yeah, I mean, the sticky conversation is making its way into the numbers, and risk is performing well. but there's a lot of risk associated with that.
So it sounds like this is almost green light here for the Fed to cut by 25 next week.
Well, perhaps green light, but I would be very careful with market pricing right now. Markets are very certain that the Fed is going to proceed with a 25 basis point rate cut next week. I think the odds are closer to coin toss, honestly, because we have an environment in which Powell usually goes into these meetings with a little bit more agnosticism than the rest of his peers. And you've heard that he's talked about the economy performing better than anticipated, that inflation is somewhat hotter than expected. And yes, disinflationary momentum is still in place, but I think the Fed is going to want to be cautious going forward. So I would still anticipate a rate cut at the next meeting, but there's going to be signaling that the next few rate cuts are going to be longer spaced and that there is going to be a bit of a pause until the next rate cut, especially in light of the expected policy environment. Yes, policy makers do not guess, they don't assume, as Powell said, but they are going to be conscious of the fact that all of the policies that are being proposed by the incoming administration will have an inflationary effect.
What would the market's kind of realization of longer spaced rate cuts look like? I mean, it seemed like if you had asked us or asked any economists 2 weeks ago that it was once a quarter in 2025 that it sounded like.
Yeah.
Now, longer spacing, that might sound like once a half, maybe, once, every trimester. I don't know.
Yeah, I mean, if we start to hear that they're hesitating to that cadence, a 6-month period, there's a lot of data that they could absorb. There's a lot of numbers, obviously, every month. It would indicate to me that there is enough concern with the FOMC that they want to collect that data. I think the market expects the Fed to go to a quarterly cadence. Again, the market really only has another 3 next year once we kind of get through this December cut. If it starts to appear as if they're wavering as to whether or not they can cut, which is kind of the 6-month cadence. It's like, I want to see so much data that I can make a decision. You start wondering if you're even aggressive from that perspective. The good thing from an investor perspective is that we're not looking at rate hikes. Certainly they're going to wait to see how this administration, how policy, how tariffs actually impact inflation, whether it's transfer. There's so many questions left to answer. But if the Fed still thinks that they're restrictive, if they still think that there's a degree of comfort that they can continue going down that normalization route, the market's going to absorb it correctly. Any sign that they question whether or not they're done with this cutting cycle, that's a different regime shift.
Does that signal correction? We had a guest on yesterday that was saying that we could potentially see perhaps 10% pullback sometime in the first half of next year. Is the Fed changing of the tone something that could trigger that?
There's a lot of momentum in kind of this soft landing type of discussion in the market. I think we would have to parse it with a lot of different things. Sure. It's still a soft landing if the Fed isn't hiking, right? If the Fed isn't looking at needing to retighten, it means things are good. You still have to figure out what companies are going to win, which companies might be a little bit off sides, particularly with these tariff discussions. But it still shows an economy that's pretty solid. And to me, that's an important factor in all of this. Valuations are hard. Everything's expensive.
Marvin, is the market, though, too quick to discount some of the inflationary risk that Greg was talking about going into next year? So then what type of risk then does that pose when we're trying to figure out just in terms of, I guess, how quick of a reaction we could see in the markets? What do investors then need to know?
You know what, so I'm a rates guy. I spend a lot of time thinking about what this one number is 10 years in the future means. Probably the biggest risk in my mind is that whether it's debt sustainability and or inflation volatility, if you will. The view that the current uncertainty around inflation goes away and just is stable in the future, to me, is really a big jump forward in terms of just being comfortable with the market. If we think that inflation is really on an up and down path that we've seen going forward, we're not being paid for that risk within the rates market, if you will, and that number affects every other asset class.
Best projection for what you think the terminal rate could look like from the Fed, given some of the cadencing that you were talking about earlier?
Terminal rate today or the terminal rate whenever they get to the terminal rate? That's a big question because disinflationary momentum is still in place. Fundamentals are still disinflationary. We're still seeing more cautious consumer spending, which is limiting pricing power. We're still seeing wage growth being disinflationary, given how strong productivity is. And we just had the lowest pre-pandemic readings in terms of rent and OER. That's also disinflationary. So yes, I think the Fed is going to proceed more carefully as it searches for neutral in an environment where policy uncertainty is likely to be inflationary, but we're likely to settle at a rate that's closer to 3% than it is to 0 as it was before the pandemic.
Thanks for reminding me. I need to go back and renegotiate my lease terms on my rent. Thanks so much, Marvin and Greg, for taking the time here with us this morning. Appreciate it. Let's send it now over to our own Jared Blickry for a look at the movers on the back of the November CPI report. Hey, Jared.
Thank you, Brad. Let's dial up the Wi-Fi Interactive behind me, where we have a risk-on rally, and we can see that most notably in the Russell 2000, that's up 0.2%. You can see it was just oscillating around the flat line most of the night, and then we got a nice pop off of the report. And I'd add, by the way, that at one time, 1/3 of the gains in this 2-year bull market have been attributed to CPI. In other words, those gains just came on CPI day. So this has been the biggest driving report, bigger than jobs day, bigger than the Fed days of this bull market. And so we're seeing a continuation of that today. And let's check out the rates market, speaking of rates, where we see futures. Now, this is a 2-year U.S. Treasury note future, which moves opposite the direction of rates. So that's heading higher, means rates are heading lower. That is a risk-on flavor to the market. So that's a 2-year. Let's check out what the 10-year is doing. That is still negative, but you can see we got a nice pop there. That 10-year is coming down, though not quite at the level that it settled at yesterday. And let's take a look at S&P 500 futures real quickly. We're not quite at record highs here. I'm going to put a 3-month chart of the futures. Looks pretty similar to the normal S&P 500 ticker that we use. I didn't draw that very well. We just came down to basically horizontal support there, and it looks like we're trying to lift off. So we'll see if that holds. But let's check out the gold market and the silver market. We've got a nice 4-day pop in gold, and we have exceeded those November highs. So that is another bull leg for gold that is in the works there. That is a confirmed bull leg. Here's silver futures. That is in an up leg as well. And we can also take a look at WTI crude. We don't expect this to necessarily move on this particular report, but it's interesting. This is just consolidating, waiting to break out of this negative trend line here. You got to think that if and when it finds that catalyst, it'll develop some momentum. And I'd be remiss if I didn't check Bitcoin as well. Sometimes we see a little risk on, risk off action in Bitcoin, and I'm going to put a line chart on there. You can see it's just kind of ticking to the upside there, just short of 99,000. So Bitcoin's still trying to really break out of that 100,000 level definitively. And finally, let's check in on the US dollar. We're going to look at the US dollar versus the euro. Actually, the other way around, the euro versus US dollar. That's heading up a little bit. So that's strengthening the euro. That's showing strength in the euro, a little bit of weakness in the dollar, but really not a lot of movement there. And the dollar hasn't been under a lot of pressure either way. So that's been beneficial for risk markets. And then here's the sector action, how it's shaking out in the early going. The background color is what happened yesterday. So tech was down 1.4% yesterday, but it is up 0.6% this morning, followed by consumer discretionary. That's been one of the best performing sectors since the election. That's a retail trade. Then we have energy, financials, utilities, communication services, rounding out the top row. I'm going to leave us on Apple here. Apple's up 0.2% in the pre-market. It has been hitting record highs recently. Let's put a year-to-date chart on. You can see, yes, it finally was able to break free of its trading range, trading to the upside, up about 30% year to date, and again, up about 0.2% in the pre-market. Guys.
All right, Jared, thanks so much for breaking down some of the action that we're seeing here soon after the print. Well, coming up, we will have more on the November CPI report and a look at what categories saw the biggest price changes this past month. That's coming up next on Yahoo Finance.
Continuing our coverage of the November CPI report, our next guest says stronger economic data and the prospects of an incoming Trump administration have led him to pare back his expectations for rate cuts over the next 2 years. He now sees 125 basis points of cuts, at most through the end of 2026, though. We're joined now by Dennis Gartman, chair of the University of Akron's Endowment Committee and former editor and publisher of the Gartman Letter. Great to have you here with us. Let's kind of look out into your crystal ball as you kind of look through 2025 and clearly out to 2026 now. What is some of the cadencing that you're anticipating now with some of the trends that you're seeing locked in after a CPI report like this?
Well, first of all, the CPI report this morning was a yawner. It was exactly as expected, and there were no surprises whatsoever, either in the month over month or the year over year. They were exactly on target. And I think if I were a Fed governor or a Fed president, I would be voting to do nothing at the December meeting, holding rates steady, waiting to the new year to see whether I want to see any other cuts coming through. I used to think that we'd have 250 to 300 basis points cuts in the overnight Fed funds rate from the high. Now I think it'll be at most 150 basis points, maybe 125 over the course of the next year and a half or two. And that's just, given the strength of the U.S. economy, which continues to be surprisingly strong to me, and it's going to continue to be that way. The Trump administration will bring in deregulation and will, I think, spur economic activity quietly going forward. So the propensity for the Fed to continue to ease monetary policy aggressively, I think, is now behind us. No question about that in my mind.
Dennis, is inflation back to being that critical variable?
Inflation is always a critical variable, but I think it's less critical than it was. Clearly, there's been a demise or a slowing of inflationary pressures for some time, and I think that shall continue. That's the reason why I'm going to cut my expected cuts in the overnight Fed funds rate to only 125 to 150 basis points over the next 2 years. But inflation will always be a problem. It's going to continue to be a problem. And I think that the inflation rates, we got close to 2%. I don't think we could take it under 2% over the course of the next several years. And I think we go back to 3 or 4% over the course of the next 2 or 3 years. No question about that in my mind.
And why is that, Dennis?
Just the trend, the Fed's balance sheet, it continues to hold at about $7 trillion, down from $9 trillion. They seem to be moving towards a continuation of that asset size that they've had for the past several years, and I don't see any reason for them to change that. I think that grain prices have seen their lows, and I think food prices have probably seen their lows. Look at what's going on in cocoa, look at what's going on in coffee, look at what's going on in sugar. And now look at what's going on in the grain markets, which have stopped going down, and I think we're going to start to go higher. So I think inflationary pressures from commodities prices will be much stronger. Well, I shouldn't say much stronger. Will be stronger next year than has been anticipated.
And what about on shelter, especially as this report indicated that it's still making up and driving roughly 40% of the mix of inflation right now?
That's not going to go away anytime soon. We have a shortage of housing in the United States, no question about that. And that's going to continue for a long period of time going forward. So the food prices are going to be higher, housing prices are going to be higher. The only thing that may be lower will be energy prices. Take a look at the term structure in the crude oil futures. We had an immense backwardation. Now that backwardation has narrowed rather dramatically, which tells me that crude oil prices, given the fact that we're going towards a contango rather than a backwardation over time, that's the only place that I think we can have some deflationary pressure is from energy. I think WTI gets under $60 by the middle of next year without too much difficulty. But that'll be offset by the fact that grain prices will be higher, livestock prices will be higher, food prices generally will be higher. So you'll have higher input costs for food and lower energy costs, which is the only offsetting balance on going forward.
So, Dennis, just given the inflationary risk that you are seeing, the fact that maybe it makes sense for the Fed not to move at the next meeting, what is it then, the biggest takeaway for investors from this print heading into the new year? How should they then be positioned?
I think share prices are extremely expensive. They seem to be going from the lower left to the upper right, and I've been remiss in not being bullish of shares for the long period of time. But I think share prices are extremely expensive, and the fact that you're getting 4.5% to 5% in overnight Fed funds rates and money market certificates, I think that's going to be, for the average investor, a riskless rate of return, which is not a bad rate of return over any protracted period of time. So I say 3 to 5 year Treasury securities seems to me to be a great place to hide money for the next year or two, no question in my mind.
Dennis, as you're looking out to 2026, that also triggers the thought that we'll have a different Fed chair likely at that point after Fed Chair Powell's term comes to an end. What do you think needs to be the passing of the baton, or at least the handoff, to continue to hit some of the targets that you even have for this FOMC?
I think the next chairman of the Fed will be Kevin Warsh. I think that's almost a given the fact that he was up for the Secretary of Treasury, but was delayed, and Mr. Powell will probably not be returned after his period in time in the chairmanship ends in 2026. So I think Kevin Warsh will be the next chairman, and he tends to be somewhat more of a monetarist. We'll see what happens when that goes by. But between now and 2020, the end of 2025, the early 2026, the Fed composition will not change dramatically. So there's very little change as far as I'm concerned. We have a little bit of a slightly more bearish tenor coming from some of the regional presidents next year, but that's modest to say the very least.
All right, Dennis Gartman, always great to have you. Thank you so much for taking the time to share insights here this morning. I want to take a deeper dive into that CPI print out this morning and to some of the biggest categories in the November CPI report. We're joined now by Madison Mills and Alexandra Canal here to break it all down. And Ali, let me go to you first, because I know you've been digging in to the shelter component of this, which has remained sticky, but we are seeing, I think, a little bit of progress in this.
Yeah, some moderation when it comes to the rate of those price increases. The shelter index rose 4.7% on an unadjusted annual basis. Now, this was lower from October's 4.9% increase. Month over month, we saw shelter prices rise 0.3% after rising 0.4% in October. Now, we do know that shelter contributed to nearly 40% of the monthly increase in overall inflation, but if you compare that to the October report, shelter was accounting for over 50%. So again, a bit of moderation there. Now, sticky shelter has been largely blamed for these higher readings that we've been seeing in core inflation, that coming in at 3.3% for the fourth consecutive month in a row. Now, last month, we did get the chance to speak with Minneapolis Fed President Neil Kashkari. He did categorize housing inflation as the big elephant that is still out there, although he said that as rates come down over the next year, that we should see some relief. Now, if we dig into the categories within shelter, the index for rent and owner's equivalent rent each rose 0.2%. That's a deceleration from October. Owner's equivalent rent is a hypothetical rent a homeowner would pay to own the same property. Now, the lodging away from home index stood out to me. That rose 3.2% after rising just 0.4% in October. So a pretty significant increase there. Shelter just continues to be sticky. I don't think we're going to see a ton of relief immediately, but hopefully the fact that we're seeing some of this moderation in the increases is an encouraging sign.
Yeah, certainly. And Maddie, you're watching food. I'm hungry already. What are you seeing?
Oh yeah, lots of good news on the food front, but a little bit of a mixed picture that paints a really interesting picture moving forward about the difference we're seeing in prices for those more expensive versus less expensive items here. Starting at the headline number though, index for food increasing 0.4% in the month of November, up from 0.2% in the month prior. That's up 2.4% year over year, as you can see on your screen there. Food away from home, I'm always looking at that, ticking up just a bit, 3.6% increase year over year. Now, as we know, Donald Trump, he said he was elected over the price of eggs. We saw a huge reversal to the upside in the price of eggs for this month, up over 8% after a decline of 6.4% last month. So still seeing a lot of volatility there. Beef, important for you, Brad, up 3.1% here. The index for meat, poultry, fish, and eggs moving to the upside. Now, interestingly, to that point I was making earlier about the products that lower income consumers tend to buy, we've heard this from General Mills on their earnings calls. Cereals and bakery products falling 1.1% in November. That's the largest one-month decrease ever reported in that sector. And JP Morgan's David Kelly this morning already saying that this CPI print is a little bit of a sign that the wealthier products are going to continue to move to the upside, whereas we're seeing a little bit of relief for those products that perhaps lower income consumers are continuing to buy here.
I don't know who told you that I do a Command F for beef in this report, but your sources are accurate.
I heard a little bit of whispers before I started here.
Maddie and Ali, thanks so much for taking the time. Appreciate it. Before we head to break, let's check in on the markets here this morning. Futures, as of right now, they're higher across the board. The Dow futures up by about 0.2%, S&P 500 futures up by about 0.4%, and the NASDAQ futures higher by a little more than 0.5%. We have more CPI coverage ahead after the break.
It's 9 a.m. here in New York City on this Wednesday, December 11th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
First up, U.S. stocks push higher following the November CPI report, which showed inflation came in line with expectations from Wall Street. The report leaving a rate cut on the table as the Federal Reserve meets next week in Washington. Meanwhile, Bank of America strategists are warning that the stock market is underpricing the risk of the return of inflation as equities have been trading in a Goldilocks environment. They say this time CPI matters more.
Plus, earnings season continuing with more results out this morning. Macy's shares falling after the retailer trimmed its profit outlook after concluding its investigation into employee plot tied millions of dollars in expenses. The company is also facing some pressure from activist investors to form a separate real estate unit and consider spinning off its luxury brands. Meanwhile, shares of GameStop getting a bid after the video game retailer reported a surprise third quarter profit despite falling sales. Sales in the latest quarter were down 20% from a year ago when GameStop reported revenue just over $1 billion.
And President-elect Trump has picked Andrew Ferguson to serve as the chair of the Federal Trade Commission. Ferguson is one of two Republican members of the FTC and joined the agency last April. As an FTC commissioner, Ferguson has dissented from several of the current chair's rulemaking efforts, including a ban on non-compete clauses in employment contracts and rules to make it easier to cancel subscriptions. Now, corporate America has criticized the current chair, Lina Khan, for blocking too many mergers on antitrust grounds. Well, U.S. stock futures are pushing higher this morning as inflation came in line with estimates as market participants now price in a 25 basis point rate cut at the Fed's next meeting. There you're taking a look at futures on your screen, fractionally higher across the board as of right now, off of the back of this print that, as we mentioned, came in line with expectations here. But it's still shelter, driving 40% of the gains in inflation that we had seen for the most recent month in November here.
Yeah, Brad, I think when you take a look at these headline numbers, yes, it did come in line with expectations. It looked like that is good enough, at least for the market here today. We didn't see a huge surprise to the upside. So that, of course, would have been a bit worrisome. But I do think this is a clear message from the recent data points, what we are collecting and some of the trends is that the disinflation trend that we had been seeing, it really looks like it has stalled for now. And I think that is the critical question going into the Fed meeting next week. And ultimately, when you take a look at some of the policy initiatives or plan here going forward into 2025, that's very much top of mind for investors. Because yes, we have seen significant improvement when you compare it back to the numbers that we saw in 2021 and 2022, 2 or 3 years ago. But yet, when you look at the disinflationary trend and more importantly, what we have seen lately, that improvement looks like it has stalled. So I think how big of a factor that is going to be in the Fed discussion, in the Fed meeting next week and looking ahead to 2025. When you take a look at the market pricing, they're very much viewing this report as a green light here for the Fed to cut next week and cut by 25 basis points. But like you and I were just talking to Greg Dacco, the chief economist over at EY a few moments ago, he was saying that he doesn't necessarily think that maybe that is the right move, or maybe there should be some trepidation, should be some reconsideration just in terms of how exactly the Fed should be approaching the inflationary picture right now.
Yeah, as of right now, we're looking at a 98% probability of a 25 basis point cut according to the CME Fed Watch tool here. And I think back to what BlackRock had really said earlier this week in their weekly market commentary, what really matters here is that you continue to see CPI prints show service inflation staying sticky but on solid wage gains. So kind of comparing what we got last week in the employment report with this week's CPI print and making sure that we don't get back to a point where inflation is outpacing some of the wage gains, because that will really kind of spell a more not all-out dire situation for the consumer, but one that certainly does kind of tilt the axis just a little bit and really cause the markets to rethink exactly how resilient the consumer is able to be in outpacing and trying to outpace inflation as well.
All right, let's dive a little bit deeper into this report and figure out where inflation is progressing and where prices remain sticky. We want to bring in Claudia Sahm. She is a former Federal Reserve Board economist and current chief economist at New Century Advisors. Claudia, it's great to see you again, and thank you so much for making the time to join us here this morning. I'm curious just to get your first take of this morning's report and really ultimately what that signals for the Fed.
Right, so it was another firm CPI print. And so we've had 4 months that have firmed up again. And, I think as we get towards the end of the year, these data releases, it's good to step back in big picture on the year. Yes, you can think about inflation progress has stalled in recent months, but you can also really put a pin on the fact that we've made progress, especially over the past 2 years, but it has been uneven. And we are back in one of those uneven patches. It's not alarming, the kinds of numbers we're getting. They're still moderate, but it's frustrating, particularly when you think about something like shelter, which really the forecast was by this point that was going to be back to normal. And that is not, and it really has continued to keep these numbers quite elevated. So it's been a real lesson on how inflation works. And we haven't quite figured it out yet.
What is the likelihood that we see any type of normalization in shelter, and at what kind of timeline would you expect that?
So I think the big lesson in these normalizations of disruptions that happened in the pandemic, and the shelter disruption was early in the pandemic, we had big spikes in new tenant leases and people moving around, is just it takes a very long time because two things happened. We had huge disruptions. Right, so we had very big price increases in the tenant leases early on, and then that process of adjustment takes a long time. And then we have, and we have contracts and just the way prices are put together. Like the Fed is our inflation fighter in terms of the policy tools, and that's what we go at it. But demand is not all that's behind inflation, and it's just been really tricky. These more contract prices, long-term prices. It's just the time horizons have been longer. So we are still going to be working through this next year, right? This is going to take more time.
I guess when we're trying to figure out when the inflation print number, when CPI will get below that 2% level. And instead of trying to time that, the timeline's obviously impossible to gauge right now. But what do you think are the critical factors? Obviously, further improvement in shelter, but in terms of how confident maybe the Fed will be that we are eventually going to see that continued progress?
Right. And we also have to be careful what we wish for here, right? It is very frustrating that we haven't gotten inflation back to the Fed's target. Now, the Fed's target won't mean CPI is going to get all the way to 2, right? It's going to probably hang a little bit higher. It does historically. But we can get back to 2 pretty fast, but that's a collapse in demand. That's a very aggressive Fed. That's a recession. And we don't want that. So this slow grind, this disappointment of it's taken longer to get there, but we are now into more moderate numbers, right? For the pace of inflation, we have slowed inflation down quite a bit. It's, how fast we get to that target. It has both the policy decisions of the Fed, it has how some of these contract prices work themselves out. But then it also has what else happens in the world. Right? We had a really good year in terms of demand and growth and consumer spending. Yeah, that did slow us down some, but 3% growth, maybe it was worth it.
Claudia, if we see tariffs get implemented next year, does that absolutely torpedo the Fed's 2% target? And do we see an adjustment off of the back of that?
It would. Increases in prices that show up temporarily, as tariffs would often temporarily in inflation, so the increase in price, it would push out probably when we see the Fed's preferred inflation measures get to 2%, just, because it takes time, the arithmetic works out. That doesn't necessarily mean that the Fed looks at those tariffs and reacts to them by, say, increasing interest rates or not cutting interest rates, right? Like the Fed, a tariff, if it is targeted, if it's narrow, if it looks like it's going to be a temporary effect on the price on inflation, well, then the Fed really should look through it, which means they shouldn't react to it because it's not their inflation battle to fight. Now we're going to get a lot more details on the policy, both what the administration decides to do and then how other countries react to it. So tariffs are a real wild card in terms of the inflation outlook. But it's not necessarily it's a complication, but it doesn't necessarily derail the progress on inflation at 2%. Prices will be higher.
Is it too early to almost start to draw out some of those scenarios, just given the unknowns and given the fact that obviously, even if we do see tariffs go into effect next year, it's more of the 2026 problem?
It's appropriate to draw out the scenarios. I don't think it's time to be reacting to them. Right? Even the Federal Reserve has said they're drawing out those scenarios. They're thinking about what the different characteristics are, when they would react, when they wouldn't react. But we shouldn't expect them to be, when they're giving us guidance next week on what they plan to do next year, it's probably not going to be coming out in that guidance because it's too soon. Just like I think it's too soon for consumers to be worried about tariffs are coming, and so they go out and make purchases now that maybe they wouldn't otherwise because they want to get ahead of the price increases. Like, we don't know enough to really be changing our behavior, and doing that too soon. We could be overreacting to stimulus, but we should be ready, right? And doing scenario planning is the way you're ready, so you see it coming.
Claudia, thanks so much for the time this morning. Really appreciate getting some of your insights and perspective coming off the back of the November CPI print. Thanks.
Great, thank you.
Let's get a check-in on some of today's market movers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to get to Macy's here, delivering its delayed third quarter results after concluding its investigation into an employee who hid millions of dollars in expenses. Yahoo Finance's Brooke DePalma joins us now with more on the numbers. I even saw you writing up a story here, Brooke. You've been doing it all right on set.
It's certainly been an early morning, but Macy's did in fact conclude that internal investigation. We now know that cumulative delivery expenses totaled $151 million. That employee did in fact act alone, and it was in no means based upon personal gains, but was indeed an error from that employee. It did happen over the course of Q4 2021 to the recent quarter, which ended in early November. Now, in an 8-K filing early this morning, Macy's said that this was because of material weakness and internal control over financial reporting. The company did say this has not had an immaterial impact on financial results, with no impact to revenues, cash, or inventory, and all vendors were paid properly. But CEO Tony Spring telling investors this morning on a call that we've identified and begun to implement additional controls to be a stronger and more disciplined organization so that an action like this could not happen again. Now, the company did have to lower its full year profit guidance because of these delivery expenses and the adjustment from that. The company now does expect adjusted profit for a share of $2.25 to $2.50 versus its prior forecast of $2.34 to $2.69 for the full year 2024 outlook.
Certainly has been challenging, to say the least, for Macy's, for Tony Spring during his first few months as CEO. And then there's also the pressure from activist investors. And we had Barrington Capital. I know you were all over that story earlier this month and some of the developments there. Did we learn anything just in terms of where things stand with those discussions?
Yeah, not mentioned of on the call, but we do know that this is the second activist investor that's been knocking on Macy's door just this year. I believe this is the fourth in the past decade. We know that Barrington Capital Group and Thor Equities have really piled on the pressure to Macy's to improve shareholder value here. They're really looking to Macy's to improve what they say the value of their luxury business. That's Bluemercury, the cosmetics business, and Bloomingdale's. Both did see low single-digit same-store sales growth in this past quarter. These two latest activist investors also calling on Macy's to improve their real estate value, they say. Those two activist investors, shareholders, say that real estate could be worth between $5 billion to $9 billion. Macy's did up how many stores it plans to close by year end. It is now at 65 instead of a previous expectation of 55 versus a previous expectation of 50. But we asked Tony Spring at Yahoo Finance Invest his response to these activist investors, and here's what he had to say.
The board unanimously voted in favor of parting ways from the discussions and focusing on the strategy of the company. You're going to have those things happen. And again, our strategy was not a 1 month or a 1 quarter strategy. Our strategy is a 3-year strategy, and it's creating sustainable, profitable growth.
And to be clear, that was in response to the active investor over the summer that they have since ended discussion with Brigade and Orkhouse Capital Management. The company did say in its Q3 results that it has posted asset sale gains of $66 million during the quarter because of those store closures. But really, Macy's remains confident in this bold new chapter strategy. Whether or not it will work, the street seems pretty mixed.
All right, Brooke, great stuff. Thanks so much. Stick with another trending ticker that we're watching this morning, and that is GameStop, reporting a surprise profit in the third quarter, boosted by some cost-cutting efforts. This coming despite the video game retailer sales falling 20% from a year ago. You're looking at gains here of just about 3%, putting that in context with the moves that we have seen most recently with GameStop. Not a huge reaction to this print, but when you take a look at these numbers, it's clear that some of these cost-saving efforts that have been underway at GameStop are paying off, at least for now. And we know they have been closing stores. They have been focusing on selling those higher margin goods. That looks to be at least helping with some of the fundamental numbers, at least up until this point. And I think the big question going forward, when you take a look at the core business, take a look at the fact that it's still struggling to really ramp up sales of its video game hardware, some collectibles there, the pressure that it's facing from some of the larger players within the space. When you take a look at Amazon, when you take a look at eBay, that story has not changed. And that really was one of the focuses here of Michael Pachter, analyst over at Wedbush, that we have talked to time and time again about the investor story surrounding GameStop. And to no surprise, he was saying that there is no turnaround, just stock sales to willingly foolish investors here. So there is lots of questions. Obviously, to no surprise, the fundamentals of this business still very much in question, but at least we did see some improvement on these numbers.
We did. It's also a business that needs to raise cash and has done so. They put together an at-the-market equity offer that essentially kind of added on to what they already needed to do and did do back in 2021 as well, even coming off of the fanfare. And so ultimately, when you're thinking about needing to bring on more liquidity, getting more capital here, that at-the-market equity offering, they sold 20 million shares. They raised about $400 million here. They still are a company that does not have an earnings call. So as of right now, there's not too much additional insider color that you're getting from the executives there. But if there's anything that you can sense in the environment and how the investor sentiment has really shifted in at least the social chatter around this name in 2021 then versus now, it seems like there's a lot more social chatter around companies that actually have some fundamentals plus have leadership that are either extremely viral or are just able to communicate better on social media. And it seems like Palantir, Tesla, we talked with Matt Kors, host of the Matt Kors show on YouTube, about this recently, and he said that that's exactly where it seems like some of the mentality shifted towards companies that actually have fundamentals, and then looking at the year-over-year, quarter-over-quarter growth that actually shows to be more phenomenal than what we're actually seeing with GameStop and not having to hope for a profitable quarter, which is what you're having to do with GME as of right now.
Yeah, exactly. When you take a look at the stock performance here, I mean, the company has made moves to take advantage of the rise that we have seen. It's sold about raising around $3 billion earlier this year through some of those share sales. You can see that 1 year chart that we have up on the screen, up just about 73%. When you take a look at the cash and cash equivalents here at the end of the third quarter, that totaled just around $4.58 billion. Putting that into context, that was compared to just $4.19 billion the previous quarter. So we are seeing a bit of an uptick there as well.
Absolutely. Well, coming up on Morning Brief, everyone, we're going to count you down to the opening bell on Wall Street. Stocks trading in the green after the CPI print came in line with expectations. Plus, we'll break down what's next. Hey, Shauna, Kroger and Albertsons as a judge blocks the mega merger. And on the other side of the break, we've got former Cleveland Federal Reserve President Loretta Mester. There she is, reacting to the November CPI print. All that and much more coming up.
Welcome back to Yahoo Finance Live. I'm Jennifer Schonberger. For more reaction to this morning's CPI report and what it means for the Fed's policy decision next week, I want to welcome into the program former Cleveland Fed President Loretta Mester. Loretta, thanks so much for joining me. It's always great to see you.
Thanks, Jennifer. Glad to be with you.
Your reaction to this morning's CPI report, and how do you think the Fed is viewing this?
Yeah, well, it came in as most economists expected it to, but from the Fed's point of view, the unfortunate thing is that it does show that we've had sort of a stall out in the progress that was made earlier on inflation. And I think that's got to be a bit of a concern to the Fed in the sense of, I do think they're going to be slowing down at least what they thought they might be doing in September. Remember, we had a summary of economic projections in September that suggested they would do another cut this year and then 4 more next year, 4 more 25 basis point cuts next year, or 100 basis points. And I think that's got to be rethought because there's just a lot of underlying momentum still in the economy, and inflation is not showing much progress over the past 4 months. So I think there's going to be a rethink about what that appropriate policy path may have to look like next year, even aside from prospective fiscal policy actions, which are still largely unknown, but we know are coming.
Before I get more into how many rate cuts you think we could see for next year and whether that gets scaled back, do you think then that there's a risk that inflation is stalling here and perhaps settling at a higher level versus tougher comparisons, and that we could see, as we go into the first quarter of next year, perhaps inflation come down, given that inflation spiked so much in the first quarter of this year?
No, you're right. I mean, there are these base effects, and you have to think about those as you're forecasting out inflation. But, you know, we're going to get the December SEP, and that'll really give us a very good look of how the Fed participants, FOMC participants, are thinking about what's going to happen to inflation. If I were forecasting, I would have to, well, certainly, you know, the median will go up because I just think that we haven't seen as much progress. So we're going to see, I think, certainly for 2024, they're going to have to raise what they had in the September SEP because the data is basically in and we know what inflation is going to do. They'll have stronger growth for this year. Now, next year, the numbers may not be that much different, but it may be that the policy path to get those numbers will have to be changed. And I think that's more likely. I think they're still going to say, and I think this is true, that inflation is on a downward path. We know it's a bumpy downward path. It's not every month we see a number that shows inflation coming down. But I think it's going to take a bit longer than they probably thought it would in September, and it'll probably take more restrictive policy than they thought in September. Not necessarily that the Fed will be raising interest rates, but the policy path will be firmer than what they thought in September, I suspect.
So then, Loretta, do you think they still cut by 25 basis points next week? And given your sentiments, what do you think the median forecast settles out for next year? Are we looking at 3 rate cuts, 2 rate cuts versus the median of 4 that we saw penciled in September?
Yeah. I mean, 2 or 3 next year seems about right to me, but the medians can move on, depending on what the mix around the participants is. But I think it'll definitely be fewer than 4. The December meeting, they haven't really prepared, and they had some opportunities to tell the markets, hey, we're really contemplating a pause at this point. And frankly, whether they pause in December or go ahead and do that rate cut, which is you could justify based on sort of the progress that has already been made on inflation, and then think seriously about maybe pausing in January so that they can pause and assess what's likely to be coming next year in terms of inflation and also the employment part of the mandate. We can't forget that important part of the mandate either. We've had some numbers that suggest that things there certainly aren't as the risk to the downside in the employment part of the mandate have eased since September. So again, the economy seems to be on a good footing, and the upside risks to inflation have risen, the downside risks to employment have fallen. And so that means that the policy path going forward will be probably firmer. I mean, I think that they're more likely to follow through in December and then think about next year. And, they'll be able to talk, the chair will be able to speak in the press conference about how they're thinking about the coming year and whether something's fundamentally changed in their view that inflation's coming down. I don't think it should. I think that the best, the modal forecast is that inflation will be moving down and there'll continue to be progress, but it'll probably take a bit more firm funds rate than they were expecting to have to do. I think they still want to get toward neutral, but I think it'll just take them a little bit longer to do that.
And quickly, before I let you go, we did hear from President-elect Donald Trump this past Sunday on Meet the Press that perhaps he's looking at tariffs more towards a negotiating tool. Of course, we don't know, how that will play out, whether we'll see retaliation from other countries, how long tariffs could be levied, the level of those. But generally speaking, how do you expect tariffs could impact monetary policy decisions and the path for policy next year?
Well, I think the Fed is going to be doing some, and I hope they're doing sort of investigating by their models, sort of what are plausible alternative scenarios for tariffs, and then running them through the model so they'll get a sense of the impacts. Tariffs, it really depends on where the tariff is put on, which goods, whether it's passed through into prices to consumers depends on what the elasticity of demand is for that good. If consumers don't react much when there's price changes, the producers will pass that tariff on. But on goods where consumers are very much willing to, pull back on spending, then the producers will take it. So there's going to be relative price changes. Typically, you think about tariffs as being like a supply shock, which means it's going to increase prices, but then the inflationary impact will be flatter. But of course, I'm loath to say that because we had rolling supply shocks, during the pandemic and after the reopening of the economy, and we did see inflation. So I think the Fed's going to be attuned to that and making sure that it's doing the analysis and talking to businesses. That's one thing that the reserve banks are very good at. They go out and do a lot of reconnaissance with businesses to see how they're planning to react. And then they can feed that into their thinking about the outlook for the economy and therefore appropriate monetary policy.
All right, Loretta, we'll have to leave the conversation there, but thank you so much for your insight. So appreciate it. We'll see you soon. We'll be right back
Thanks,
after
Jennifer.
this.
That's a look at today's bell ringers at the New York Stock Exchange, Olin, and at the NASDAQ Coin Check Group, kicking off today's trading session. Let's take a look at the major averages here as we begin the day. And there you're hearing the bell ring. Okay, so ultimately we begin the day down. This is after we had seen futures pointing higher coming off of the back of the CPI print. So a little bit of a pullback here that we're seeing. The Dow Jones Industrial Average right now is down by about 0.3% here. If I can just keep control of this for a hot second. The NASDAQ composite, you're seeing that down by about 0.25%, and the S&P 500, you're seeing that down to start off the day by about 0.3%. Let's go over to the heat maps where things move around as expected here, and we're taking a look at the XLC communication services sector, of course. That's up by about 1.5% to begin today's trading activity. You got more laggards, though, than leaders as of right now, just 3 leaders in the green. XLRE, that's pulling up the caboose. It's down right now by about 1.6%. And then just lastly, we'll ride out with a look at the NASDAQ 100 for the, okay, all right, well, that's not going to populate for us. So I'll toss things on over to Yahoo Finance's Jared Blickery with a look at what's moving. Hey, Jared.
Well, thank you, Brad. I thought we'd start out with the Dow today, and we'll dial up the Wi-Fi Interactive behind me. Dow is trying to snap a 4-day losing streak, so let's punch up a 5-day chart and see where we are today. Here's the 5-day. You can see down 1.5%, and it looks like we're extending it right now. But let's take a look at the NASDAQ composite as well. You can see that is up 0.5% over the last 5 days, but it's in negative territory today. And the S&P 500, that's down as well today, and it's down over the last 5 days. I want to take a look at the VIX as well. The VIX was originally heading down, and this is actually the VVIX. Let's see if we get it. Wi-Fi Interactive is doing its own thing this morning, so we'll see. Why don't I just skip over to the sector action, where we did see, we saw consumer discretionary leading earlier today, or excuse me, communication services. Then we have staples, then we have financials, then we have consumer discretionary. But communication services had a nice boost thanks to Alphabet yesterday. But the stock I've really been focusing on is Apple as well as Tesla. And Apple has been hitting record highs, even as the rest of the market has been under pressure. And it doesn't look like the Wi-Fi Interactive wants me to chart you an Apple chart or a Tesla chart. But let's go to the semiconductors and see what's going on there. Semiconductors have been coiling for a breakout on a rather medium term, if not longer term basis. And here's the sector action, or excuse me, here's the semiconductor action today. Nvidia down 2.5%. Broadcom is going the other way. It's up 0.5%. But for the most part, you're seeing a lot more red than green. So tech kind of taking a back seat today. I've also been following unprofitable tech, which is the ARC innovation components, and we'll see if that dials up in a second. But you know, it's really been about the Mag 7 over the last, 1 week, 2 weeks. We've seen in fits and starts, we've seen some of the smaller stocks kind of assert themselves, and we saw that initially after the reaction. But December has mostly been about some of the larger stocks. And here's a big one right here. You can see to the right, all those smaller stocks, those are in the red, but Tesla up 2.2% today. And let's take a look at the 5-year chart, because Tesla is right up to these record highs that we saw in 2021. We'll see if it can exceed. Just needs a catalyst, right? For everybody who's looking at this potential breakout pattern, remember that a lot of times you get a handle. Now, there's so much excitement over our Tesla, I wouldn't be surprised if it just rockets higher, but sometimes there is a consolidation phase, so that's what we'll be prepared for. Shauna?
Jared, the markets and the color on the screen and the heat maps is always Christmas themed, but the Grinch really doing a number on our Wi-Fi Interactive here today.
Yes.
You guys did a great job navigating it,
We
though.
tried.
You did, and you're pros. All right, Jared, thanks so much. It's time now for our strategy session. November CPI data coming in line with estimates, but the lingering threat of inflation does pose some risk to Wall Street's bullish outlook for the stock market. Let's talk about that. We have our very own Josh Schaefer. And Josh, I guess how big of a risk, or how should investors be assessing that risk as you take into account some of the look aheads that we've got?
Yeah, so we've been talking for about a month now about the 2025 outlook generally being bullish, right? Most strategists see somewhere from 6,400 to 6,500 for the S&P 500, which is about 8%, up past 7,000, which would be a 16% rally. So overall, there aren't a lot of bears on the street right now. But one of the top risks they're talking about is inflation. And it's because when you look at that CPI print today, you're not seeing inflation make a lot of progress right now. That is just kind of the net of the last 3-4 months of both CPI and PCE, economists calling inflation going sideways. And the question is what that sets up going into 25, right? Part of that could be, does the Fed not cut in 25? Now, strategists would tell you maybe that's not an issue for stocks. If the economy is doing well, maybe we don't need Fed rate cuts in 2025. But that, again, puts more pressure on the economy doing well. It also might move rates higher right now, right? So if you're looking at a 10-year right now in the 4.2% range, some rate strategists would argue maybe it's actually in the 4.5 to 4.75 range. You missed some opportunity there, right, if you bought the 10-year at 4.2%. When you think about it from a stock perspective and potentially this Trump trade, one thing that the team over at UBS Asset Management was telling me yesterday is, well, what if Trump knows that inflation being high obviously isn't good for the American consumer, and part of the reason he was probably voted in was because the incumbent party was there during inflation, right? So what if he doesn't do these tariffs? He starts to realize maybe the tariffs aren't a good idea if we're still not really getting inflation down like we want. Well, what's the trade been in the market for the last month, right? It's been a Trump trade of tariffs, people sort of betting on the different policies. Maybe that impacts some of this, and maybe it also impacts one of the other consensus calls, which has been for US exceptionalism. If the US is going to put tariffs on everyone else, the theory is, well, that will hurt European economies, that will hurt emerging market economies. Maybe it won't actually hurt them as bad, and there's chances for opportunity outside of the US stock market is one other option. Again, this isn't a lot of people's base case necessarily, but it is something I think that people are going to be continuously talking about as we get into 2025 and if these inflation prints don't get any better.
So all that considered, it seems like one area that there is a ton of consensus continues to be within financials right now for next year, because one of the other policies that is talked about is just the sweeping deregulation that is expected, and as evidenced even more so by the now selected FTC person that Trump is going to be bringing back into, well, it's already within the FTC, but now going to be elevated as commissioner.
Yeah, Brad, that's definitely a consensus call right now. It's hard to find a strategist that isn't overweight financials, it feels like, right? We know they all come on, they list about 3 or 4 sectors that they like. Seems like everyone likes financials, and I think that's because, as you were just saying, the deregulation aspect there isn't necessarily at risk from the inflation concept that I was talking about, right? That seems like something that Trump could do perhaps either way. I think the other key thing that is a part of this story for us is, okay, financials, but what are some of the other sectors people are overweight right now? It's a lot of cyclicals, right? It's a large bet that the US economy and the trend that we've seen over the last 3 years that the US economy outperforms expectations is going to happen in 2025. If that doesn't happen and inflation is sticky, it just creates a very interesting picture for both investors and possibly the Federal Reserve, right? Because if your economy is weakening, the labor market starts weakening, one would think rate cuts. But if inflation isn't making progress, can you confidently make rate cuts and bring inflation down? That seems like, while we're talking about inflation being sticky, again, the economic growth aspect of this also remains super, super key.
And that's what has made this entire last several years, just in terms of Fed policy and how complicated the current dynamics are right now within the economy. When you take a look underneath the hood at some of the driving factors, I think that very much just illustrates how tough it is for the Fed to best gauge and why we have seen so much discussion and so much, I don't know if I'd say disagreement, but I think very lively discussion and commentary from Fed policymakers over the last several quarters in particular that show very varying views just in terms of what should be done, what's necessary, and really how much progress has actually been made ultimately on inflation.
Yeah, there's just a lot of fog going into 2025, right? I know strategists are using that word, and it's sort of, but I think it's a true word, right? And I was speaking to EY chief economist Greg Dacco before he came on earlier with you guys, and we were sort of talking about, well, why are they still cutting in December, right? And it's maybe just to finish out the path that they set forward on this year. The Fed finishes out with this cut in December, gets to closer to neutral where they wanted to be to end 2024. And then you just wait for all the variables to come in 2025. A lot of things can certainly change in 25. So maybe you do one more cut, and then you say we're going to be gradual and data dependent, and no one likes to hear the data dependent word. But I think it matters a lot going into next year when we're talking about all the things that can impact this economic data. If there's one thing that's clear, inflation isn't falling like a rock like it has been at points over the last 2 years. And so where it is going to head is a big, big question.
Yeah, got a note here from BlackRock as well, saying they encourage consumers who are sitting on extra cash to participate in the market to avoid losing out to inflation. So it's starting to play in a little bit.
Inflation isn't always bad for stocks. That's
not.
definitely something we've learned over the last 2 years, right? And something to keep in mind.
Josh, thanks so much. Appreciate it. Coming up, everyone, what deal making could look like under a new FTC chair. That's next on Morning Brief. Time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at deal making under a new FTC chair. Hey, Maddie.
Hey, Brad. So let's take a look at that deal making here, because as you know, President-elect Donald Trump has selected Andrew Ferguson as the new head of the FTC. He is currently one of 5 members of the FTC, one of the 2 conservative members, so he doesn't have to go through the same approval process as the other selections of Trump for his new administration here. Now, what we know about Andrew Ferguson, he has said that he is anti-big tech censorship and very pro-First Amendment, and those are 2 things that Trump has called out about why he likes Ferguson for the top job. So what does this mean for Wall Street and for deal making? Well, I wanted to take a look at the muted deal making activity that we had seen heading into the November election here. You can see this is all of 2024 at the end of this chart, and just in the few months heading into the election, a steady decline every single month heading into that election. Now, if I can flip the board over here, I wanted to show you just the uptick in deal kickoffs we saw just in the 1 week after Donald Trump was elected in the United States. We saw a 44% increase in deals kicking off. So just a huge amount of bullishness in deal making moving forward. And of course, as we've seen with some of the regulation on deal making, even as recently as these last couple of days with Kroger and Albertsons, that fear about regulation has sort of fallen to the back end in anticipation of changes under the incoming administration here. So the main reason you're seeing this uptick, it's deregulation, but you've also got anticipated corporate tax cuts and also, of course, further cuts to interest rates, which are both potential catalysts for deal making moving forward here.
All right, Maddie, thanks so much for breaking that down. Well, President-elect Trump's selecting Andrew Ferguson to replace Lina Khan as head of the FTC Federal Trade Commission. Ferguson is currently a Republican member of the commission. Joining us now, we want to bring in Bill Baer. He's the former United States Assistant Attorney General. Bill, it's great to have you back here on Yahoo Finance. Talk to me just about what we could expect from Andrew Ferguson. I think more broadly speaking, the reaction here this morning, at least on Wall Street, has been a bit friendlier, much more friendly to some of these M&A deals than what we saw under Lina Khan. What are you expecting?
I expect there would be a little more leniency towards M&A, but not a dramatic difference. The courts have been pretty supportive of the challenges that Lina Khan and Jonathan Kanter at DOJ have brought in the last 3.5 years, and they are focused on really problematic mergers like Kroger, Albertson. So while there may be more leniency, I don't expect a dramatic change.
And so with that in mind, as you're looking at some of the potential deal making that's already been talked about among some of the top executives at companies here, what is the big difference that we could see in how these deals are structured and the types of companies that might look to come together in order to outpace everything from some of the challenges that they could see due to anything from tariffs to just broader market forces? And which sectors do you think are most ripe to see some of these efforts to consolidate?
It's a little early because, Commissioner, soon-to-be Chairman Ferguson really hasn't talked about this at great length. At the same time, in the tech sector, you could see some consolidation. You could see some support for domestic firms, not just in the tech sector, but also various chips trying to get bigger to deal with China more effectively. Now, the tariffs may in fact strengthen the domestic firms without the need for further consolidation. But early to say, but probably see some people trying to take advantage of what they expect to be a more lenient antitrust environment.
Are big companies, though, when you take a look at Lina Khan obviously targeting the larger companies, you take a look at Ferguson's past comments and what he has said about big tech, and kind of going back to what you were just saying a moment ago, it sounds like at least the approach here to to larger companies, and maybe if we want to focus on big tech, is unlikely really to change much.
That's an early indicator. There has been a lot of Republican support for these monopolization challenges to Amazon, to Google, both Google Search, Google Ad Tech, to Facebook. So I expect those cases will continue.
All right, let's talk about the latest news that we got out from Kroger, its proposed acquisition here of Albertsons. Obviously, that was challenged by Lina Khan at the FTC. We just got that ruling last night. What are the next steps? Is there any hopes of any sort of reversal or any sort of change then coming from the Trump administration?
Well, the parties have a right to appeal, but you have two courts who ruled yesterday, one in Washington, a state court, and then a federal judge in Oregon, and they basically, in very detailed opinions, said the same things. There's a lot of BS in what Kroger says is going to happen if this deal is allowed to go through, and the facts just don't support it. Kroger and Albertson are each other's closest competitor in many markets all across the country. And because they're closest competitors, if Kroger is allowed to absorb Albertson and its various brands, it will have extra pricing muscle. It will be able to raise prices. And there was a proposed divestiture to CNS, which has an absolutely horrible track record in trying to run retail stores. It may be a good wholesale distributor, but I expect the commission will continue to pursue these cases. But even more likely, it's that Albertson and Kroger will just give up. Albertson gets a huge reverse breakup fee. I think it's $600 million. And I think this deal goes away, and frankly, it should.
And so what does that mean for the broader kind of grocer landscape right now? Because you still have a company in Walmart that, accounts for over 20% of the overall market here. And it seemed like these two coming together might just try to strengthen their own ability to operate and go up against Walmart's, or even more so the Amazons on the digital side and digital delivery. So where does that leave kind of the rest of the market mix here if this deal does not go through?
Well, Brad, both judges found that Walmart is not as direct a competitor as Kroger and Albertsons are with each other. So I think the landscape doesn't change very much. The parties argued that Walmart, Costco were really the firms that were driving their respective pricing behavior, but the facts just never bore that out. They don't. They compete directly with one another. They rarely price check Costco, a little bit more of Walmart. So the problem Kroger and Albertsons had here is what they said in court didn't at all measure up to what they do every day in the marketplace.
Bill, there's also lots of questions about what exactly is going to happen with Nippon Steel and his proposed purchase of U.S. Steel. We know Trump has said in the past that he wants to block it. I think the big question, at least from my mind at this point, is what that protectionist strategy is going to look like under the Trump administration. And maybe what do you think that then tells us about the future of some of these foreign buyers and the interest that we could see, or lack thereof, that we could see in U.S. companies going forward?
Well, we haven't seen what actually is going to get done and what is a threat and what is going to be a reality. But I do think the president-elect's opposition to the Nippon Steel move into the United States does foreshadow a real skepticism about being willing to embrace investments or takeovers by foreign companies of U.S. firms.
Bill, thanks so much for taking the time here with us today. Appreciate it.
Thank you.
Coming up, everyone, Apple, Albertsons, General Motors. We'll break down some of today's trending tickers. Stay tuned. We're taking a closer look at some trending tickers this morning, and we're doing it in 30 seconds each. Let's go. First up, we've got Apple reportedly working with Broadcom on an AI chip, according to the information. The chip is expected to be ready for mass production by 2026. Shares of Broadcom, they are higher on the news, and Apple's seeing some slight gains too here this morning.
Plus, Albertsons filing a lawsuit against Kroger, claiming willful breach of contract over Kroger's failure to, quote, exercise best efforts and to take any and all actions to secure regulatory approval for its merger. Now, Albertsons is seeking billions of dollars in damages. This comes after a federal judge blocked the deal on Tuesday over competition concerns. I also want to quickly point out that Albertsons has also authorized a $2 billion share buyback and also boosted its quarterly cash dividend to 15 cents a share.
And finally, General Motors will stop funding its robotaxi unit, Cruise. The automaker plans to merge Cruise into its broader technical team. GM will instead focus on autonomous driving for personal vehicles. The company expects restructuring costs to lower spending by more than $1 billion annually. Shares of GM, they're up on this by about 0.5%.
All right, keep right here on Yahoo Finance. Coming up next is Catalyst. We're going to break down the biggest or have more analysis on what is driving the markets today. We've got that for you coming up next.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's take a look at the three catalysts that we're watching this hour.
First up, we'll break down what to expect from the Federal Reserve as inflation came in line with estimates.
Plus, we discuss the global outlook for oil as OPEC cuts its growth forecast for this year and next. How will geopolitical tensions impact the commodities market?
And we'll take a look at the picture for global trade amid President-elect Trump's tariff threats. What could a trade war mean for shipping and consumers? We'll discuss all that and more right here on Catalysts.
Let's take a look at some of today's market headlines to start the hour. This is sponsored by Tasty Trade. Take a look at the major averages. You're looking at a mixed picture now. We did briefly see movement to the upside following the CPI print that we did get out this morning. But now you've got the S&P back below the flat line. You've got the NASDAQ off about 0.25%. You do have the Dow, though, holding on to some slight gains, up just about 80. Flipping over to the bond market, that's really where we saw the reaction to this print. You got yields moving to the downside, off now just 3 basis points, at just below that 4.1 level. And taking a look at the dollar and seeing some of that movement there. Here we know that that was also on the move following the print that we did get out this morning. It is still moving to the upside here as we take a look at that trade. Yet we have the dollar index moving to the upside, up by just about 0.2%. All this following that November CPI report that we did get out this morning. There was lots of questions just about where things stand right now, Maddie, just in terms of some of the progress that we have seen, the lack of progress that we did see in this report right now. And I think what this tells us about where we are in that disinflation story and how much of an issue, the fact that it seems that we seem to have that progress stall just a bit, how big of an issue that is for the Fed and policymakers here as we look ahead to the meeting next week. And Yahoo Finance actually had a chance to speak with former Cleveland Fed President Loretta Mester earlier this morning about the report, how she thinks the Fed is going to respond. Let's take a listen.
It does show that we've had sort of a stall out in the progress that was made earlier on inflation. And I think that's got to be a bit of a concern to the Fed. I think that they're more likely to follow through in December and then think about next year and then think about seriously about maybe pausing in January so that they can pause and assess what's, likely to be coming next year.
So Loretta's comments there really mirrored by the market. We're seeing swaps looking at a 90% chance of that cut in December, but a question remains about what that neutral rate is going to look like moving forward, given that disinflation is starting to not come through the way that the Fed and perhaps investors had anticipated. We're seeing core goods and energy. They have stopped moving to the downside as significantly as they had previously. That could be a headwind to bonds throughout the day here. I also thought it was really interesting what David Kelly over at JP Morgan had to say earlier today, talking about this idea that the more expensive goods, that's where we're seeing stickiness, but the cheaper goods, we are starting to see more of that disinflation picture. So maybe some relief for lower income consumers that could lead to a better picture for that 2% target for the Fed. But of course, the next data point that will potentially tell us what they're thinking about is that summary of economic projections we'll be getting in next week.
Yeah, and that's really going to be the focus, right? When you take into account what we got at the last time that we did get the dot plot, what now the market is pricing in just about 3 cuts. Now there's talk that maybe we could only see 2 cuts as you look ahead to 2025. And just a question just about how restrictive policy currently is, how restrictive policy would be if we do see 2 more cuts here from the Fed next year, just in terms of fighting inflation, if in fact we do see a continuation of some of the stalling on the inflation front. So lots of questions for the market to digest. Let's get into that and more as we have investors turning their focus to the new year. For that, our next guest has 3 market themes that you need to be watching for 2025. We want to bring in Jim Tierney. He's the Chief Investment Officer of Concentrated U.S. Growth at AllianceBernstein. Jim, it's great to have you here. And I think one of the first themes that we want to talk about, and it's clearly a focus here of investors as of late, is AI. How critical, how big of a theme is that going to be in the market next year?
Really has dominated the market this year, and I think it will dominate the market next year. But I look at this as a train ride, and the first stop on the train was the semiconductor companies, and they benefited greatly in 2024. The next stop is who are the implementers, the hyperscalers, the software companies that will benefit. And ultimately, the third stop is everyday companies, but that'll take a while to get to that point. So I'm looking at 2025 as the year of the software company and how do they implement it and how do they sell it?
What does that mean for the Magnificent Seven? Because we are seeing profit growth estimates slowing. They're still huge, but slowing for the Mag 7 names. Does that mean the way to play AI in 2025 might be looking outside of those top 7 companies?
I actually think some of the Mag 7 are perfectly positioned. They've spent a ton of money, more than $200 billion of CapEx this year, probably more next year, with not a lot of visible return yet. But the key word there is yet. I think in 2025, we'll start to see that ramp up. Microsoft is a great example. They have Copilot out there. The results so far have been a little bit disappointing for investors, and it's probably why the stock hasn't kept up with some of the other Mag 7 stocks. But as they sell more of it, as companies embrace it, I think Microsoft is really going to get a bid here, and people are going to get excited about Microsoft again.
One of the other themes, or your second theme that caught our attention, was power consumption. And maybe on the surface is not something that sounds too sexy for our viewers here, but it is very interesting just in terms of that opportunity and what you think investors need to be watching for. So tell us about that and why that is critical here in the new year.
Because of efficiencies, we haven't had any growth in power consumption for decades. And we're starting to get to the point where there will be growth. Reshoring is a big opportunity. Data centers use a whole lot of power. So not only do we need more generation, but we need more transmission and we need more storage. All of that, if you say, well, it only grows 2 or 3%, the spending that you have to do in today's dollars is massive. Mm-hmm. So I think that's going to be an underestimated long-term driver of economic growth in the U.S.
Is there a name in the space that you're looking at?
Eaton is a great way to play it in terms of whether it's generation, whether it's transmission, whether it's storage, whether it's data centers. They play in all of those, and it's a U.S.-based company. The majority of their U.S. sales are manufactured in the U.S., so if tariffs come to pass, I'm not really worried about Eaton.
You know, that's so interesting, Jim, because I was just at Goldman's Industrial Materials Conference last week, and Eaton obviously an outperformer within that space. So it sounds like you actually think there's a lot more runway for that growth. I guess, what does that growth look like?
Exactly. Everybody thinks this is a 1 or 2 year trend. This is going to be a 5, 10, 15-year trend, both in terms of reshoring and data center usage.
To that end, too, I'm interested in your take on the impact of tariffs. We've spoken with lots of guests who see it as a big headwind for the macro picture, as it could lead to inflationary pressures. But I know there's one name in particular that you see as a beneficiary of tariffs because of the currency impact it could have on the peso. Talk to me about that.
I think you have to be careful in terms of where the tariffs are. Are they a threat? Are they a reality? And the threatened tariffs with Mexico and Constellation Brands. Constellation Brands is a brewer of Mexican beer. They exported out of Mexico to the U.S. Will tariffs be implemented against Mexico? Who knows? But with the depreciation of the peso over the last few months, much of that has already been offset. And instead, you have a company that's trading at 16 times earnings, cheaper than it's been in years and years, with growth in the consumer staples space. It's a real consumer staples growth company, tariffs or no tariffs.
How big of a risk, though, is tariffs?
Oh, it's meaningful, and do you want to pay 20% more for your beer or whatever it might be? Of course you don't as a consumer. So you have to be careful about how they're implemented, but I think it's more a threat than reality.
All right, Jim, thank you so much. We really appreciate you making time for us this morning.
Thank you.
Thank you. It's now time for some of today's trending tickers. You can scan that QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. We're going to take a look at Netflix. JP Morgan raising its price target to $1,010, up from just $850. Yahoo Finance's Alexandra Canal joining us now with more on what's behind the raise. Ali, what's this call about?
Well, we've seen a decent amount of price target raises over the past few weeks as the stock just keeps pushing higher, reaching all-time highs since the company reported third quarter earnings in October. Shares are up over 30%, up about 90% since the start of the year. Now, Doug Amick from JP Morgan, he called out the company's strong content, healthy organic growth, and ramping ad tier contribution. Now, that combination convinced Amick to raise his Q4 subscriber net addition target to 10 million, up from the prior 9 million. And this would be about double the 5.1 million the company reported in Q3. And it does make sense considering we're going to have the second season of Squid Game coming up at the end of December. I was at a UBS media conference in New York City yesterday, and co-CEO Ted Sarandos, he kept talking about the healthy content pipeline. And he said this is going to be the first year that there are no impacts from COVID, no impacts from the writers and actors strike. So there's a lot of content coming out in the new year. He also talked about that Jake Paul basketball Mike Tyson fight. He said that the event stretched the capabilities of the internet itself. Remember, that had a few technical glitches, but he said compared to where we were a year ago when they had that disaster with the Love is Blind reunion, it's been a pretty significant ride forward. And of course, we have that upcoming NFL Christmas Day game, so that'll be another test there. And that live opportunity, something that analysts have consistently called out, especially when you think about the pull-through effect that will have on the company's advertising tier. Netflix expects to reach meaningful scale in all ad tier markets in 2025. They also noted that the company will drive significant monetization in 2026 when it comes to ads. So that future runway growth, another catalyst for this price increase. And we didn't even talk about password sharing crackdown and the price increases that Netflix could implement, which they have said that they're open to. So just a lot of things going right for this company right now, but we do have some on the street that think valuation is too high. They're really operating like a growth company, and obviously that just increases the bar so much more.
Yeah, and Ali, I also thought the comments that you wrote up just about consolidation and kind of where things stand, and given Netflix's history, the fact that they are builders, I believe is what Ted Sarandos has said. I'm curious what you make of those comments, just in terms of how that compares with the narrative that we've heard from the street. And we've had this expectation of more and more consolidation within the industry. I guess that might not so much pour cold water, but I think that does make you at least second guess maybe how much activity we could potentially see, or Netflix's role.
Yeah, Netflix, the exact quote was that we're better builders than buyers. They did have done a few smaller acquisitions, but they say when it comes to future consolidation, that's not something that really makes sense for their business right now. They said, looking across at other legacy media companies, some of their competitors like Disney, Warner Brothers Discovery, Paramount, it makes sense for them because they are stressed under the kind of pressure from the deteriorating linear cable bundle. But for them, it's not something that they're really focused on or worried about. And I think it just speaks to their positioning within the streaming marketplace. They are clearly number one. They have made a lot of strides. They have a lot of first mover advantages as well. And so far, things seem to be working well organically for them. Now, things change all the time. Remember, they never said they were going to have ads. Now they have ads. They never said they were going to crack down on passwords, but they are cracking down on passwords. So I think it'll be interesting to see next year, especially with the incoming Trump administration, what that opens up and which companies potentially want to divest, want to sell, and what activity that we could possibly see. But I think for now, Netflix, they're sticking with their guns. They just want to be alone in this war, in this streaming marketplace. But again, we could see that change.
All right, Ali, great stuff. Thanks so much. Well, coming up, OPEC cutting demand expectations while Exxon plans to pump out even more oil. We get a check on the outlook for the energy market. That's coming up next on Catalyst.
ExxonMobil will raise its capital spending next year as it's set to acquire Pioneer Natural Resources for $60 billion and increases its oil production plans. The energy giant plans to spend between $27 and $29 billion of cash in 2025. And this comes amid a bit of a glut in supply for the broader industry. And this is what is so fascinating about this story when it comes to Exxon, because it's completely thwarting its competitors in the space. We saw Chevron last week announcing the first cut to annual capex since 2021. They're saying that they're prioritizing profit over production. And meantime, as we mentioned, the OPEC Plus alliance is extending that plan to withhold crude from the market into next year. You also have Exxon continuing to outperform its competitors in the market since the pandemic. So it's interesting to see that they're ramping up their capex while their competitors in the space are having to tighten up a bit.
Yeah, exactly, Maddie. You almost took the words out of my mouth, because that was the direct comparison I was going to draw, just in terms of what we are hearing from Exxon this morning, comparing that to what we heard from Chevron most recently, what we heard from OPEC this morning, just in terms of cutting the demand growth forecast and what they are seeing. Actually, the fact that they've actually lowered it now for 5 straight months in a row. So that really puts into context some of the trends that we have been seeing play out in the market over the last several weeks. And when it comes to Exxon specifically, and what we did hear from the oil giant this morning, the budget increase was much larger than what the street had been anticipating. So RBC, I thought, was out with interesting reaction this morning, saying that that might actually inspire some skepticism among investors, just given the fact that some of those investments involved and there was embryonic projects here. So again, just the fact that they remain in their nascent areas today, lots of questions just about maybe some of the skepticism that could rise from the numbers that we are getting here from Exxon. But I think, to me, the most interesting part of this story is the contrast and the gap that we're seeing between what we're hearing from Exxon versus what we heard from OPEC and what we've heard from some of its largest competitors within the space in terms of what they are expecting for demand, not only for the remainder of this year, but of course, as you look ahead to 2025 as well.
Absolutely.
Well, OPEC cutting its forecast for demand growth for the 5th month in a row. This coming after delays to its planned output increases. Joining us to discuss the outlook for energy, we want to bring in Dan Dicker. He's the founder of the Energy War. Dan, it's great to have you here. So here we have this outlook from OPEC, the fact that it did cut its 2024 demand growth forecast for the 5th straight month this morning. What's your assessment just of how this sets up then the energy market heading into the new year?
Well, Sean, it's been a pretty depressing kind of view on crude oil that we've had for the last 6 months, last half of 2024. I continue to believe that 2024 was really the kind of pivot year for not fossil fuels, but crude oil specifically, in that it's not going to be the growth story it was in the past, and we have been pivoting on clients out of crude oil and into natural gas and renewables because of that. You see it in some of the obviously you see it in the price of crude, which has been particularly flat over the last 6 months, and did not really react as much to even the inflationary periods during the pandemic as other goods and services did. So it is a very depressing kind of view if you're trying to find investments inside the crude oil space. Other energy spots are very bright, particularly in natural gas, LNG, and in the coming of the increase in renewable usage. Chinese incentives for conversion into EVs and AI power centers. All of this is leading towards a more electricity-based kind of energy portfolio going into the new year, and that's where we're kind of pointing our investment here.
How vulnerable is the broader market then to a shock from oil prices moving forward, given not only the moves we're seeing from OPEC, but also the broader geopolitical landscape?
I'm not really sure that there's much in either direction to be had. Obviously, the upside has not been affected much by geopolitical rifts. I mean, the latest actions in Syria did nothing for the market, basically, and it hasn't. A geopolitical dust-up in Ukraine didn't do much for the markets, at least long-term. On the downside, I don't think there's much on the downside either. We've seemed to have found a very decent spot of sort of equilibrium between supply and demand, although there is a systemic glut that's on the market. But it's been very clear that the markets do not price well at sub $60 and recover from there fairly frequently. So again, we're looking for pretty much a range-bound crude oil market, at least for the first half of 2025. And for investors, that's not much opportunity to be had.
Dan, when you take a look at the U.S. market specifically and some of the promises or direction that we're likely to see under President-elect Donald Trump, he's setting up the new National Energy Council. He has this goal of U.S. energy dominance. What does that then tell us about some of those opportunities that are likely to arise within the industry? And I guess how realistic do you think some of these hopes or promises are within the space?
Yeah, this has been the wild card, Sean. I think you hit it on the head, and the question becomes really how much can a president do, even one as kind of rearward facing as Trump is with his energy policies. If you remember in his last administration, he tried to bring coal back from the dead and had some success with it for a couple of months, but ultimately, it faded back into what is sort of a natural progression of what's going on here in energy. The natural progression that's going on is clear. It's away from crude, it's towards natural gas, it's towards renewables. I mean, that's where it's headed. And the question becomes, how much can Trump slow that or reverse that with, his ideas on energy and our thoughts of that, not a whole heck of a lot.
Well, it's interesting because before Trump enters office, obviously the Biden administration is still in office, and Biden, we have seen issuing some potential legislation that could impact the oil market. Some reporting from Bloomberg News that the Biden administration could sanction parts of Russian crude. How are you thinking about the potential for that to actually come to fruition and the impact that that could have on the price of oil?
This is more political than it is going to impact the energy markets. Again, I think that a lot of what Biden has been done specifically towards Russia has been to sort of, in some ways, try and insulate Ukraine against a possible settlement that the Trump administration, when they come in, is going to look to push upon them. Less of an impact, I think, on the oil markets than it is on Ukrainian sovereignty, if that's the way we're going to look at it.
Dan, what are the top trades then heading into 2025?
I think there's no question. You need to focus on crude oil stocks more like bonds. They're going to be very steady. Nothing wrong with them. They're going to deliver a good dividend, and you can rely on them to be there for 10, 20, 30 years to come. It's not like crude oil is going to disappear from the energy portfolio, but if you're looking for real alpha, you need to look towards the renewables, specifically those that are concentrating, for example, in the generation space. The names are not unknown. Someone like a utility like Constellation. Others, maybe the nuclear space. Centrus has had some volatility lately, and it's hard to know where to get that, but that seems to be something to be worth having. Next Era, those are the kind of names we're looking at. And then the LNG space, Accelerant has just made a big move from the lows from $10 or $12 to close to 30. There are clearly some investors who are searching around for the next great thing in energy. What I would say is it's not crude oil.
All right, Dan, thank you so much for joining us. As we head to break here, let's get a check-in on shares of Alphabet as they hit a record high here. You can see they're up 3.7% right now, climbing over 4.5% earlier in the trade here. Now, this comes after the biggest one-day gain yesterday for Alphabet since April, following a development in their quantum computing through the use of their Willow chip, much anticipated by the market here. And we certainly saw a positive move to the upside on Apple, again, hitting a record high in the trade this morning. Perhaps a little bit more excitement for that Willow chip coming into the market here, not all of it getting priced in yesterday's trade. We'll have much more ahead on the broader market moves right here on Catalysts. Healthcare industry leaders grappling with the public response to the killing of United Health CEO Brian Thompson and assessing whether changes need to be made in the industry. Yahoo Finance spoke with Mark Bertolini. He is Oscar Health's CEO and the former CEO of Aetna. Here's what he had to say.
While this act in itself was unconscionable, the behavior of the American public in reaction to it is understandable given how frustrated people are with the state of our healthcare system in the United States.
Joining us now with a look at how the industry is responding, we've got Mike Desjardins. He is Anomaly's CEO. Mike, thank you for coming in here. I just want to get your reaction both to what you heard from Mark and how you're kind of viewing the response that we've seen from the public to this.
Yeah, sure. Thank you for having me. I wish it was under different circumstances. It's a worthy conversation. I had a chance to catch your segment with Mark live, so I've been thinking about this for a bit. And Mark's a guiding light in our industry. I think the first thing I'd say is one of the things that I've been viewing and maybe struggling with is some of the moral equivalency that folks are talking about here. I want to make pretty clear that what we witnessed was a crime against a person on their way to work, and a crime against the society that we go to work in every single day. And today it was healthcare, and tomorrow it could be any other industry. So I think my own personal reaction is surprise there.
How are you looking at this as a healthcare CEO, just in terms of the reaction? While it is a tragic event, I think the industry just can't dismiss some of the outrage and unhappiness that we certainly are seeing play out within the sector and with the insurance industry at large. There are some changes that have long been advocated to change within our healthcare system. What are those? Or I guess, what do you think is the most necessary in order to start on that path to improving the healthcare industry?
Sure, great questions. And the word actually I liked most was long. These have been challenges that we've been struggling with as a country for almost 80 years. That was actually one of the things that Mark did say in the segment that made a lot of sense. I mean, ever since employer-sponsored healthcare, things have kind of gone awry. A company I used to work at, the advisory board company, we did a survey of people's views on healthcare. This was more than 12 years ago. And we ranked all healthcare, not just health insurance, but right next to the IRS in terms of people's kind of Net Promoter Score. So this is a big challenge, and I think there's lots of complexity here, and there is no single segment to blame. But I would say it starts with, in healthcare, there is no real transparency, and there's no real agency for you and me. If something goes wrong, who do we call? Where do we go? We don't know what things cost. We don't know what things are covered, right? We're told what to do in healthcare, and I think that's where it starts. I mean, a good analogy, most folks don't kind of know the guts of healthcare, but a good analogy, today, before I came here, I went to get coffee, right? I chose the place I went. I went to Gregory's, it's pretty good. And I chose what I wanted. I looked at the price. I live in Virginia, it's $4, New York, it's $8. But I agreed to pay for it. And when I left, no one's gonna run me down for bills. Nothing's happening behind the scenes, right? We don't have any of that in healthcare. Somebody tells you basically what doctor to go to. That's usually your insurance carrier. Your doctor will tell you essentially what you need, right? And you trust that that's the right thing. You've already paid for your insurance, you trust it's gonna pay. You leave, and hopefully, you're on the path to being well. But so often in healthcare, behind the scenes, there's this whole industry figuring out what to bill and whom to bill. That part of healthcare costs $500 billion a year. And it's done wrong more than 20% of the time. So to you might not get a bill, you might get a bill. And if you do, that bill might be $4 and it might be $84,000, and you really have no idea why or nowhere to turn.
I think that's such an important pain point for individuals. It could either be $0 or hundreds of thousands. It's very difficult to suss out the exact price of these goods. And I wonder what you think about whether companies should be in charge of fixing that, or if it should be something that's coming in terms of regulation moving forward. And this is something that California Representative Ro Khanna spoke about earlier this week. I want to get a listen to that and then get your response.
Sure.
There is no justification for violence, but the outpouring afterwards has not surprised me. My view is very simple. Why can't we have a rule that if a doctor prescribes something and if Medicare, traditional Medicare, is going to cover it, then private insurance companies should be forced to cover it? I mean, it's absurd in this country what's going on.
So this is a debate that is a tale as old as time. Should it be private or public sector regulating this space? What do you think?
Sure. We already have a public-private partnership in this space, and almost except for the extremes, that's probably what we're going to have moving forward to try to get Capitol Hill and HHS and what we all want to line up is quite difficult. So I do strongly believe that there is a private sector solution here in partnership with government. And what I bring it back to is you get what you incentivize everywhere, not just in healthcare, right? So I think a lot of what folks talk about is that we have a sick care system, not a healthcare system in the U.S. We incentivize kind of after the fact, you're sick, intervention, right? And so much of that is high cost items, surgeries, for example. So I think some of what we're starting to hear potentially from the new administration is looking at that kind of a payment scheme. Might we incentivize healthcare, primary care, mental health, more than kind of incentivizing, high cost surgeries? Not that those are going to go away. We're, a great foundation for innovation, but you got to look at what you incentivize, and that really does start with government. So much of kind of the health payment scheme really is set in Washington, and then commercial insurers sort of largely follow suit. And most healthcare in the United States is distributed through Medicare. And it's important that we get that right at the top. And then there's complexity. That also has kind of a public-private partnership. So my company, we kind of live in the guts of health payment. Our goal is to simplify it. And one of the things that we look at and kind of live in is the system of codes that the health system relies on to understand what to bill. And this is something that the incoming Trump administration has actually talked a lot about.
How do you simplify it, right? Just in terms of, I think so many people out there are just trying to figure out the path forward and what ultimately this looks like and how this is going to affect them specifically in their billing, and for investors out there, how it's going to affect the space and some of these share prices a little bit more broadly. When you talk about the introduction of AI, the disruption that is leading to, obviously something that you're working with here at Anomaly, break that down for us, just more specifically what that looks like.
Yeah, so I would say the U.S. healthcare industry is an elephant. We're talking $4 trillion going to $6-8 trillion in spend, right? So we're not going to change this overnight, even if we have all of the powers of government and industry lined up. So you got to approach it in chunks. So in the ethic of crawl, walk, run, for starters, approach transparency and agency. We got to start to simplify payment before we can make payment make sense. Simplifying it means, okay, we need to know how much things cost. There's been some legislative and administrative action there. There's a lot of technology in that space right now. The second component, what we do, is figure out what's in health plans. Know before you go on what actually is covered, so you can make the appropriate changes before you get into a doctor's office. That's how you start to attack that $500 billion in healthcare spend. And it's not a perfect place to start, but if half of that $500 billion is waste, we're talking about $250 billion that we can immediately take out of the system, literally by just transacting better between provider and insurer. That's a great place to start while we think about some of the bigger, more systemic changes to incentives and structures.
Mike Desjardins, thank you so much for taking the time to join us here, CEO of Anomaly. Keep right here on Yahoo Finance. We've got much more of your market action ahead. Stay tuned. You're watching Catalysts. Chinese President Xi Jinping warning the incoming Trump administration against reigniting a trade war on Tuesday, saying there would be, quote, no winners in the event of escalating tensions. With more on what the ongoing trade dispute means for the industry at large, we want to bring in Gene Soroka. He is a Port of Los Angeles Executive Director. Gene, it's great to have you back here on set with us. Obviously, very, very timely topic. And I want to bring up a chart that Goldman Sachs actually just put out this morning. And they took a look at imports that we do see from China and what has played out in the past. When you take a look at the past impact of the U.S.-China trade war, and you can see it is the white line there that as tariffs increase, we clearly did see a drop off, maybe to no surprise, of some of those imports. I'm curious what the activity looks like at your port and whether or not you're noticing any trends ahead of the threat of more tariffs under Trump.
Well, good morning, Sean. It's so great to be back with you both on the set. This is real. Going back to 2018, when the first tariffs were put in place on Section 232 and 301 items, we saw big rushes of cargo leading up to milestone implementation dates and then huge drop-offs. Now what we're seeing is a repeat of that. A lot of run-up with the anticipation that something will be done. But we know there's a long way from the campaign trail to the implementation of public policy, and what we need now is a clear line of sight as to where and when this policy may take shape.
And we've got a chart I want to pull up too on your specific imports coming into your port in Los Angeles. And it's been interesting seeing the run up over time, but we haven't seen this huge uptick in the last couple of months following the election of President Trump. There was obviously a run up following May here. I wonder, do you think that that is based on what you're saying, that they're waiting for the actual policy implementation? Or what do you make of the trend that we're seeing?
Well, what we're hearing directly from retailers, manufacturers, footwear importers, and clothiers is that in anticipation of something happening, they are pulling inventory forward. This is real. And we've been at elevated levels all year, Madison. We're up 20% year on year. We'll wind up 2024 with our second best campaign ever in the 117 years, the Port of Los Angeles. But it's underpinned by a strong economy that's lasted a lot longer than some experts would say. And then 3 geopolitical issues. A dock workers negotiation back here on the East and Gulf Coast. Drought conditions in the Panama Canal, which seem to have settled down, but fewer container ships went through because of the loadability purposes. And then the ongoing security issues in the Red Sea with the Houthi rebels, leading to Suez Canal crossings being down by 80 or 90%. All of those issues have pushed more cargo over the West Coast. The front loading started in the third quarter and is a little more pronounced, according to those importers, in Q4.
Talk to me a little bit more about the labor concerns, because one of the sticky points when it comes to the threat of strikes, or what we could see play out on the East Coast that obviously affects you on the West Coast, is that sticky issue when it comes to AI and how, or I guess technology, and how that will then be used here at the ports. How big of an uptick? Are you still seeing an increase in cargo, just given that the fact that that threat hasn't entirely gone away? And I guess what does that indicate just in terms of how those discussions are likely then or could potentially play out?
Yeah, the short-term agreement reached earlier goes through January 15th, and that leaves us 5 days between expiry and inauguration, and then much longer before Senate confirmations take place for cabinet members. So it's kind of an interesting time. The conversation around robotics or automation at ports is real, and it's the most polarizing one in our industry. What we've seen is that robotics can increase capacity at ports and terminals, but we can't leave the worker behind. And that is the crux of this negotiation.
So where do you find the solution on that?
Well, there are models. In Hamburg, Germany, as an example, there's a terminal that doubled its capacity yet kept the workforce intact, and over time it's grown. And I think that's where the start of the conversation happens. But what we've seen, mixed results operationally, and with the implementation on the West Coast of automation, we've seen cuts at individual terminals of 50 to 80% of that facility's workforce. We simply, from an economic standpoint, locally and broadly in Southern California, need that good knowledge and workforce on the ground while trying to grow the top line revenue.
How worried are your workers about this?
Very. Absolutely very worried. And they're worried not only for the jobs that are here today, but the skills that are necessary to manage greener technology and robotics, and for the next generations of workers that come into this industry.
So how does that shape your approach, just in terms of the discussions that you, of course, will continue to have with your workers out on the West Coast, how that's shaping some of your strategy then going forward, keeping that in mind. Obviously, though, you need to cut costs. You need to be as efficient as possible. So it is somewhat of a balancing act of what you're talking about.
It is, and one of the central points of focus is the ports of Long Beach and Los Angeles building the nation's first goods movement training campus. So whether it be attract, retain, and bring in some of the younger folks for the next generation of work, or if you're more like my vintage and you need to be upskilled or reskilled, this campus, in part funded by the state of California's line item budget of $110 million, can lead us down that path. Now, it's going to be interesting because we want to train people who are not directly under the Port Authority's employ, but yet we're the first doing this, and we're out there really trying to pull together this community.
So as you look ahead to 2025, then what is your bigger focus? Is it the potential implementation of these expected tariffs, or is it the continued back and forth on the port strike?
You can't just look at one area. I think it's both of them and the geopolitical issues that I mentioned. But for every 4 containers, Madison, that we bring across our docks, we create 1 job. That's the economic benefit that's shared across this broader region that employs 1 in 9 folks, about 1 million people going to work every day with the efforts this port makes. So while we need a little bit of policy clarity coming down the line on tariffs and how we must pivot if more and more cargo migrates to Southeast Asia, we also have to keep in mind what we do to capture these elevated volumes and continue that throughput. On a last note, we moved more cargo between July and October than we did during the surge of the peak. We didn't have 1 ship backed up.
Well, and that says a lot just about efficiency. Gene, real quick, we'd be remiss not to ask you specifically about the holiday season. I'm curious just to get your thoughts or just your perspective, what you have seen the activity, how that has stacked up. Specifically, I guess it might be hard to tell just in terms of how much of this is getting ahead versus some of the other issues that we've been talking about, but just consumer demand and the shopping. How does that compare to what we've seen in past years, just in terms of where things stand right now?
Yeah. I think inventory levels were in better shape, warehouses were more fluid. And I know it's definitional now, but Black Friday number at about 10.8 billion in sales. The Cyber Monday number eclipsing 13.3 billion in sales. Overall, the retailers are pretty keen. Matt Shea of the National Retail Federation tells me that his membership wants to approach $1 trillion in holiday season sales this year between November and December. I think it's looking good for our retail community.
And it's interesting hearing that growth backdrop continuing in the midst of a slew of headwinds that you very seamlessly laid out for us, Gene. Thank you so much for joining us. We appreciate
Good to see you both.
Thank you. Coming up, could auto inflation be returning? We're going to break down those numbers next, right here on Catalyst. And as we head to the break, we're going to check on shares of NVIDIA up over 1% here. Now, this comes as the U.S. Supreme Court has dismissed an appeal by NVIDIA, meaning that the company is going to face a shareholder lawsuit. Now, the case involves an accusation of NVIDIA misleading investors about its dependence on crypto mining revenue just before the crypto winter, as it was called after the collapse of FTX. And this decision from the Supreme Court follows weeks of scrutiny that we have seen by justices questioning whether the appeal is a significant legal issue from NVIDIA. The company is the world's most valuable chip maker. As you know, they argued that the lawsuit lacked enough detail to move forward. But for now, they are heading to litigation again moving forward here. Breaking down that news, the Supreme Court dismissing the tech giant's appeal here. They will face that shareholder lawsuit. Shares still up over 1%. We'll have much more ahead right here on Catalysts.
Today's CPI print showing that auto inflation could potentially be returning with new and used prices ticking up from a month ago, but still down on a year-over-year basis. Yahoo Finance's Pras Subramanian joining us now with a closer look at these numbers. Pras, what's your big takeaway from what we saw, maybe a little bit of that resurgence in inflation?
Yeah, it caught my eye because I've been watching this number pretty closely every month here for about a year now. Basically, new cars ticked up 0.6% for November, but down 0.7% year over year. Used cars up 2% in November, up 3 straight months, and down 3.4% year over year. So a little bit of a concern there in the sense that we've seen this month over month increase in car prices. And I think what's happening is a seasonality thing. People returning to dealerships, it's sort of that high buying season end of year. But also you're seeing that automakers are controlling inventory and prices after having to slash a lot of that, especially in particular Jeep and Stellantis. I think they're gonna they're fixing that, but they're also kind of gonna be, we're seeing prices recover in the new year. So now is the time to do it. Big picture though, I think as long as that year-over-year number keeps going down, probably in a better space where we're going to go head to more normality in car prices.
Yeah, and we have heard that at least we're seeing in those two big contributors to the CPI, shelter and autos, that there's at least an idea of cooling to come, even though we're still seeing inflation to the upside. We are starting to see evidence of cooling. Pras, thank you. You're going to stick with us for our next conversation here because President-elect Trump's proposed tariffs, they could have a significant impact on the auto industry amid this sign of disinflation here. Joining us now to discuss, we've got Alex Wellen. He's Motor Trend Group CEO and president. And we've also got our own Pras Subramanian sticking with us here. Alex, thank you for joining us in studio. Obviously a lot to talk about when it comes to the auto space, but tariffs are the headwind that continues to come up for 2025 here. What are you hearing about the impact?
So we look at a lot of the different trends at Motor Trend, and I think what makes a lot of sense is tariffs, their goal is at the end of the day is to make us more reliant on our domestic manufacturing and sales, right? And to collect some money. But the auto industry has this global supply chain that is not really capable of doing that just yet. So long term, it may end up being something that really helps consumers and automakers, but short term, I think a lot of those costs will likely get passed on to the customers and to the automakers. It really depends on whether or not they actually have this saber rattling or whether it's actually going to really happen with Mexico and Canada and China.
So, Alex, one of the products that are actually made in the US most of the time are trucks. And today Motor Trend sort of named their new truck of the year, which is the Ram 1500. What is your take on why this vehicle sort of was the kind of the head and shoulders above the rest? And sort of what is your sort of opinion on that with regards to where this thing is made, which is in America?
Well, the Ram 1500 was a clean kill, and it was a little unexpected, to be honest with you. It is an internal combustion engine, so it was this Hemi V8, now it's this inline six. The engineering is excellent, the design is beautiful. It's a $40,000 car, goes 0 to 60 in 5 seconds, can tow over 10,000 pounds. It just was a real winner, and it really checked all the boxes, and it beat out, as you pointed out, Cybertruck, Rivian, the Sierra, all these different kind of mainstays. And so it just indicates kind of where we are. An internal combustion engine won this for our car of the year, for our SUV of the year, for our truck of the year. None of them were EVs. They were the last 4 years in a row, but it tells you kind of where we are today as far as the marketplace and what people need.
What does it tell us about then where we're going, just in terms of maybe some of that pressure?
We always say at Motor Trend that EVs are inevitable. I think it's just going to be a longer road than we thought. So when you look at this kind of trend, right, you used to have internal combustion over here, you still do, and you have your complete batteries. And then in the middle was this plug-in hybrid. And everyone thought that was my solution. I go 40 miles and then I flip over to gas. But there are a lot of new solutions out there right now that'll help along this journey, and it just is going to take longer. But EVs are growing, right? We hear this in process. You've written about this too. We think that EVs are flagging or slowing down. In fact, year over year, it's growing, the amount of EVs in the market share in the US, and it's almost at double digits for the amount of cars that are bought that are EVs, but they're not growing as quickly as we thought they would. So there are some solutions we could talk about, like these extended range EVs, and Ram's gonna be a leader in this. They may win a second year in a row, frankly, for car or truck of the year if they do it right, but they have a truck, okay? 690 miles. How does it do 690 miles and feel like an EV? Because they use a battery to operate the wheels, and then the gasoline is a generator that helps the battery. So it helps in the engineering side of things, and the Chevy Volt did this really well years ago, there's just new tech that will give us time to get from here to there. So if the tariffs kick in, essentially, we'll be ready for it.
Hey, so real quick, want to get your thoughts. So real quick on sort of overall market trends. Where are we headed next year? But also, we had news in the AV autonomous vehicle space with GM pulling out of Cruise. Did that sort of have any implication in your sort of determining what vehicles were sort of earmarked for that top honor?
Well, for Truck of the Year, one of the things that we loved about the Ram was that it has this assist, that it can actually drive for a long period of time really comfortably on the highway, stay in the lanes, uses all those cameras to do that. It has a lot of other really nice pieces between charging and audio and using your phone to get into the car and so forth too. But it's the autonomous piece, or at least some element of autonomy that lets you enjoy the ride even longer too. So that helped for the Ram 1500, which was excellent.
Great insight there, Alex. Thanks so much for taking the time to join us this morning. Of course, Ross, thanks to you as well. All right, keep right here on Yahoo Finance. Coming up next, it's Wealth, dedicated to all of your personal finance needs. Brad Smith has you for the next hour. We'll see you tomorrow.
Yahoo Finance has been releasing its coveted annual Company of the Year award since 2014. We'll reveal a winner in the following categories: Company of the Year, Surprise of the Year, Product of the Year, and Comeback of the Year. Be sure to tune into Yahoo Finance starting December 16th for the big reveal. Trust me, you won't want to miss this stuff.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're digging into the November inflation print. We'll break down the areas where prices have fallen the most and the least. And more Americans are investing via ETFs. I'll be joined by an expert who will give you recommendations for sectors to watch in 2025. Plus, how to talk to your family about money. We'll bring you 3 ways to start the conversation. And a bonus for today, don't miss our crypto conversation with Spencer Dinwiddie, Dallas Mavericks guard here. Also, we're going to talk to the CEO of SoulCycle about consumer trends in the fitness space. All that and much more action-packed show here. But first, let's get back to the econ data that we got this morning. In November, we saw prices rise 0.3% from the prior month. That was in line with estimates and an increase of 0.1% here. So let's focus in on some of the stickier areas here. Food prices rose 0.4% during November, with food at home, aka your groceries, rising 0.5%. Meat prices are up nearly 2% in November, and egg prices on their own rose 8.2% last month. Now, fresh veggies are up 1%, and potatoes, your favorite starch, they're up more than 3%. A couple of other areas of note here too. Used car prices rose 2% last month, although they are down on an annualized basis. Airline fares for all you travelers out there, that's up 0.4% on the month and nearly 5% year over year. Motor vehicle insurance, another hot area of conversation here. It's been very sticky. That rose just 0.1% though last month, but still up nearly 13% from 2023. Now, also in some food categories that saw relief on the other end of the spectrum last month: cereals, flour, biscuits, chicken, frozen fish and seafood, citrus fruits, soups, and salt. And one index we have yet to mention: housing. Here with the shelter numbers is Yahoo Finance senior reporter Danny Romero. Hey, Danny.
Brad, finally an encouraging report. Shelter costs posted their lowest post-pandemic gain. So let's break down these numbers. Shelter posted a 0.3% monthly gain in November, and this was lower than October's 0.4% increase and accounted for 40% of November's overall monthly increase. And on an annual basis, shelter costs rose 4.7% in November, down from October's year-over-year gain of 4.9%. Remember, there are 2 components that economists pay very close attention to and that hold the biggest weight in this shelter figure: owner's equivalent rent, OER. That's the hypothetical rent that you would earn if you were a homeowner renting out your property. OER came in at a 0.2% gain last month, and rent, which lags real-time data because the government collects rent data every 6 months, which causes a lag in this index. Rents came in at a 0.2% gain in November. Now, looking ahead, some economists believe that there could be a potential rise in rents next year due to the pullback in construction for multifamily apartments, which could pose a challenge next year. Brad?
All right, Danny, continuing to track this and, of course, the all-important shelter component of the broader CPI mix here. Thanks so much, Danny. Now time for some of today's trending tickers that we're tracking as well. Scan the QR code below to track the best and worst performing stocks of the session. You've got Yahoo Finance's trending tickers page that it'll take you to. Joining me now, we've got Yahoo Finance's Akiko Fujita. Akiko, great to see you. First up, we got to talk about a little Dave & Buster's here, missing on revenue and profit expectations in the third quarter. Company's CEO, Chris Morris, tendering his resignation. The board saying it's looking for a new CEO here. What are you kind of taking away from Dave & Buster's and this dismal quarter here?
Yeah, let's start with the latter part of the news you just mentioned, Brad, which is really what investors are reacting to here. The removal, or the resignation, I should say, former CEO Chris Morris. The company officially saying he's stepping down to pursue other interests, but this is the guy who was the key driver here in the turnaround story for Dave & Buster's. He put together a turnaround plan 18 months ago, more focused on upgrading technology as well as improving operations. His absence now leaves questions about whether in fact that turnaround strategy can be executed. Interim CEO and board chair Kevin Sheehan stepping in here. He led that earnings call, saying that he still has a lot of confidence in the underlying initiatives here, saying there's optimism moving forward. But the consumer environment, in his words, has been conflicting this year, and that remains a wild card. You mentioned what most investors would say was not a good quarter here. The company saying specifically that part of that was severe weather, a big reason, also remodeling construction that led to slower sales as well. There's a lot of analysts out there in Wall Street that are remaining cautious on this stock, specifically Truist analyst Jake Bartlett downgrading the stock from buy to hold, saying with Morse's departure, that gives less visibility into how this turnaround story may evolve, Brad.
Akiko, while we have you, medical apparel maker Figs has received a takeover offer from private equity firm Story 3 Capital Partners. This is according to the Wall Street Journal here. What do we know about this?
Yeah, the Wall Street Journal reporting that proposal was submitted on Monday here. Story 3 Capital, as you mentioned, a private equity firm, they value the company, specifically Figs here, at more than $1 billion. Current market value is a little under $900 million. And you see the stock popping in a big way today, up more than 16% in the session. The specific offer here is $6 a share of common shares. That's a big premium to where it's trading right now. The challenges have been well documented here, higher costs at fulfillment centers. They've also had to deal with less demand and slower sales. In this specific takeover offer, the private equity firm saying that Fig's ability to take the necessary steps to develop confidence around future growth, achievement, and operating margin improvement is constrained by the company's status as a public company. So stay tuned on that. But investors still liking the story, at least for today, Brad.
Akiko, thanks so much. Appreciate it. Big breakdown on both of those big movers here today. Let's also take a look at markets as we are 90 minutes into the trading day. Stocks are mixed after November's CPI report was mostly in line with expectations here, as you're seeing the Dow still down by about 0.1%, but the S&P 500 and the NASDAQ, they're holding on to gains as of right now. Joining me now, we've got David Strzeski, who is the Sound Planning Group CEO. David, great to have you here with us. Just want to get your reaction to the numbers here and what this ultimately means for how the markets are going to best anticipate the Fed's next move.
Well, Brad, as we look at the numbers here this morning, nothing surprised the market. So I think it's just business as usual. I don't think the numbers really, the market's really been caring about CPI, previous to this moment. And with all these new tailwinds coming into the new year and this new presidency, I don't really see CPI knocking that off the track. But I will say this: I am personally very cautious about inflation, and I think that inflation is absolutely here right now in the United States. I mean, when we have a print of 3%, and we've been in the 3% now since 2022, we're not going down. And in fact, we're looking at everything at all-time highs right now, and the market's looking pretty strong. And so that's actually a very inflationary environment because things are just going to continue to grow right now. So I think that could be a big surprise for the market here this next year. But as it sets right now, I think it's business as usual as we kind of finish out the rest of the year.
Yeah, it seems like, especially within the shelter component, that's the part of the mix that there really is so much uncertainty around when that will start to abate. That removed, looking across some of the other indexes, I wonder where you're also kind of seeing any correlation or pass through to how companies are navigating their own communication with customers, knowing that customers might be paying a little bit more in this interim period of time, but even amid this, there is some disinflation still on the table.
There is some disinflation, but if we look at the year-over-year numbers, we're obviously trending still higher. And obviously there's a difference between cumulative inflation, like the difference of what we used to pay prior to COVID and what we pay today. And then now we're talking the rate of change from this moment forward. The year-over-year going back to 2020 is that everything costs 26% more. So I think the lower end consumer, the middle class, is very squeezed right now, and I'm very concerned about that because we're looking at credit card interest rates going up, faster than the savings rate. And obviously that spells disaster when you understand, 20-30%, on credit cards. I don't think anyone's doing that, because they think it was a really good way of, navigating this. But here's the reality: the consumer is It has been strong and resilient. I do think, though, that as we see some of these supply side economic components come back in, that we will see some relief. But there's ultimately inflation in our system that's not abating, because when you friendshore, reshore, bring things back to the United States, that's more expensive than doing it at a place where you pay a much lower wage. So there are components to restructuring that have costs to it as well. So I don't think that there's an easy answer, but we're certainly look like we've got the right team in place to be moving forward ahead here and navigating that.
So what's the portfolio play? Because as you were mentioning earlier, inflation could still be very well around in 2025, and you still have a Fed that's going to have a target, at least at this point, of trying to get it down to 2%. Now that's their target. The reality of where it may actually linger is probably a couple basis points above 2% here reasonably. Right. So how does that pass through to the portfolio strategy?
Okay, so I think that we're going to be higher for longer. My base case is that unemployment is going to start falling apart. My base case is that inflation is going to go higher. So what do you look for when we have an inflationary environment? Well, stocks can be a great answer. Most people are already allocated to that, so I'm not going to waste your time. What I'm going to do is give you an idea that's not already in 60-40 allocations. Gold, silver, Bitcoin. You can buy things physically in the gold silver space, or you can do the miners. The miners are on sale right now, and if you look at the price that they pay in the ground for silver or gold, you're getting a discount. So that's a pretty awesome opportunity to be looking at. But gold has ultimately, beat the indexes here over the last 12 months. It's up 35%, but silver's up 39%. Here's my reasoning for silver, okay? And that is, if you look at the gold standard, a 15-to-1 ratio was how much silver we could mine to gold. It's currently 9-to-1 is the mining ratio, but if you look at the rate of exchange right now at $32 silver, 2,700 gold, you're at 84 ounces of silver to 1 ounce of gold. I'll do that deal every day of my life. And then the last one is Bitcoin. Now, finally, crypto got a pro, crypto president in Congress, and we've got all these new conversations that are happening right now. I do not believe that people recognize how scarce specifically Bitcoin is. 94% of it has been mined. We still have nearly 110 years left of mining ahead of us for the last 1 million coins. I don't think that computes to most people. It is a scarce idea by design. It continues to half and become less and less and less and more scarce as time goes along. So I think people are going to really be looking at those options as alternatives, diversifiers that can also provide some alpha here, whether the economy goes well or doesn't go as well. I think we need all three of those.
David, thanks for taking the time here with us this morning. Appreciate it.
Pleasure's mine. Thank you, Brad.
The number of ETFs launched this year has risen 15%, and U.S. assets in ETFs has grown more than 30% this year. It's according to Tidal Financial Group. Looking ahead to 2025, we want to talk about some of the themes and get some recommendations within the ETF space. Joining me now on set is Michael Venuto, Tidal Financial Group Chief Investment Officer for this week's ETF Report, brought to you by Invesco QQQ. Michael, great to see you. Great to have you here in studio with us.
Yeah, wonderful to be here, Brad. It's been a great year.
Let's start broad here. What are three sectors that you think that people should be looking at in 2025?
Okay, so the obvious one is always tech, right? But most of us own some broad-based index, and you have the big tech names. So I would look to more niche plays, something with AI like chat or blockchain. We're going to see a new administration that seems to be very interested in promoting those kind of technologies here in the U.S. So BLOK is one of the funds on our platform, things like that. I'd also look at financials, but again, I'd get more excited about things that are a little bit less big broad-based banks. The JP Morgans, more the Squares, PayPals, things like that. And then finally, it's been a surprise hit this year. Nobody would have thought it, but utilities I think are really interesting, right? Yeah. They always do well with deregulation, and it's a nice play to have if things don't go well.
Right. Also a tangential AI trade as well, yes, that we've seen play out here. I want to talk about the growth of single stock and leveraged ETFs here. What have you been able to see within the flows and how that's being used as a mechanism or at least a portfolio strategy?
Yeah, I would say that these are trades, right? There's a lot of opportunity to give people the package that they're doing on their own. Now, As an ETF, you get more tax efficiency, you get all of the great stuff that comes with a bigger scale. So we've seen massive growth in the Yield Max suite. These are funds that are basically doing covered calls, right? So you're giving somebody exposure to MicroStrategy or Tesla or NVIDIA, but you're also generating income off of it. You've also seen the other opportunities with leveraging these types of names. So I think we're going to see more and more of that. It's been a pretty exciting year for that, and it's really more people doing it themselves.
Yeah.
Yeah.
I mean, your firm filed plans with the SEC in October to launch 8 leveraged ETFs called battle shares that basically pits one stock against another. For example, leveraged long position in NVIDIA versus a leveraged short position in Intel. Just talk about the appetite that really led you to put together these types of funds and where you anticipate this kind of growing out towards in the future.
Yeah, so Title's an ETF platform. So we actually do this for clients. These ideas come to us in ways where we develop them with a client, and the client in this case saw an opportunity to prepackage trades that we're seeing retail investors as well as traditional hedge funds do. Now we're putting it in a wrapper that just simply makes it more accessible. We're really excited about it and the buzz around this one, but at the end of the day, these are trades people have been doing, and we're just making it more efficient through the structural alpha of the ETF wrapper.
I want to pivot to crypto here with some of the time that we have left. According to an analyst at Bloomberg, US spot ETFs have more Bitcoin held than the founder of Bitcoin himself, Satoshi Nakamoto. What are you seeing for crypto ETFs as you look out to 2025?
Yeah, I mean, obviously it's not going to stop, right? There's an institutional adoption that has happened, and I can't believe it was BlackRock that really kicked it off, right? You would have thought it would have been a crypto native, but it seems like...
Well, not for lack of trying, too,
not
right?
for lack of trying, yes. I do think that it's likely we start to see more, call it package product or index-based types crypto funds, right? So now we have Bitcoin and Ethereum. There are filings for Solana. There are filings for one other one I can't remember off the top of my head. We haven't seen a Dogecoin filing yet, but I would imagine it's coming. So I do think with the new regulations and things that are coming, it's likely that we're going to see more and more people accessing that market.
Michael, thanks so much for taking the time here today. Appreciate it.
Thank you, Brad.
We've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Athletes like Odell Beckham Jr. and Russell Okung are being lauded for their early foresight to convert their NFL contract agreements to be paid in cryptocurrency, and their decisions have netted major gains, with Bitcoin still sitting near $100,000. An early crypto adopter in his own right, basketball player Spencer Dinwiddie moved to tokenize his NBA contract in 2020 and embraced blockchain technology to provide fans with access to invest in a portion of his success. Dinwiddie joins us now. Spencer, thanks so much for taking the time here with us. And I mean, this has been a landmark year just in terms of the milestones for crypto. You were one of the very early adopters that believed in the underlying technology here. For a lot of athletes, though, that are trying to figure out, all right, how do I pick the right time to decide whether or not I should take payments in crypto? You know, what is that thought process? Because it's a little bit harder when you're early on in your playing career to say, yeah, just pay me all out in crypto and we'll just see where the chips fall from there.
Yeah, I mean, I think right there, it's almost kind of like two separate questions, right? I think what I was doing with my contract had a broader business focus, not solely just Bitcoin like Russell Okung, who I've had multiple conversations with, was doing. I think now when we look at investing in digital assets as an asset class, I think you need to take a long-term perspective, just like any other investment that you might have, real estate or otherwise, and just understand that the volatility is what leads to both the major gains and also the major losses. And so having that accurate risk tolerance as you step into a new asset class and not think that it's all sunshine and rainbows all the time.
You know, I wonder what milestones like Bitcoin 100,000 do for the chatter within the locker room or within practices where players are talking about, you know, maybe not so much their own finances, but their own strategies and, you know, anything outside of how they're thinking about cryptocurrency as a more broad mechanism here. You know, how has that made it into the lexicon in your own conversations with other athletes?
Well, I think as you put it, right, 100,000 basically makes it a legitimate talking point. When I was talking about Bitcoin, you know, back in 2017, and we're talking about like, you know, a $3,000 or so, or $5,000 at the time, whatever it was, Bitcoin, it's still seen as almost like a gambling chip or something, right? Like you could go to Vegas and lose, if you're talking about NBA locker room, $3,000 and not think that the world was ending, right? Like, I don't really care who you are. I think when you spend $100,000, there's a certain level of impact, right? So it makes it feel real. It's that emotional attachment to certain numbers that I think all humans kind of have just in culture, right? So I think that's what it does. And then when the conversation starts, obviously everybody starts at the top and then works through, you know, what the technology is or, you know, what other coins and communities are looking to pop.
I've lived in Brooklyn for years now, and I remember when you were with the Nets and you were having these conversations and really putting the rest of the landscape on notice for what could potentially come within this broader industry. So you certainly had the foresight. You also have a team with the Mavericks with an owner in Mark Cuban that had foresight as well. One of the only organizations that also engages with crypto and its fan experience. I wonder what those conversations have really been like and how professional sports can further embrace crypto.
Well, again, I mean, I think it's kind of twofold, right? I think if you look at inflation and what's been going on with the currency and debt, et cetera, then if you're looking for kind of a safe haven or a hedge against that, then you can look at Bitcoin in that investment in digital gold sense. And if you're looking at, you know, NBA teams and putting out products or looking at ticket sales, NFTs, things of that nature, then you start to get into more layer one technologies like Ethereum or, for example, HBAR that can, do some engaging things in terms of like ticket sales or NFTs with fans and make a better experience.
Certainly. I want to talk about one of your businesses as well, Galaxy, and where you are looking out in the landscape for the next few years, and envisioning that Galaxy will be able to leverage the momentum that we're seeing right now, especially within the underlying technology of crypto, and be able to really make sure that you're able to scale up the business as well.
Yeah, and so that's exactly where we kind of started with the tokenization of the contract. And that was, from a securities perspective, in terms of contractual value. And we opened it up to try to, do more utility based modeling, especially around creators. And so we were focused on, creator tokenization, monetization, et cetera, from a utility-based model. We then graduated to basically the super social wallet, in a sense, where you could send text and crypto via DM. And what we were noticing in the broader crypto landscape is that, community was super important. We see that with meme coins and, some of the rise of the NFTs in the last market. And so now we're really in a space of, token gated subscriptions, inspiring communities and showing different ways to, open and close communities and interact in an engaging way in a safe model, capturing microtransactions and creating a better way to monetize just the overall community experience and engagement between meme coins, NFTs, et cetera.
It's really interesting. I mean, we've seen a few scams related to meme coins recently make headlines of late. Tua coin, perhaps just the latest of them all. And I saw you posting about that, I believe, as well here. What would you say to those skeptics right now about the monetization and the broader kind of landscape for monetization that creators are kind of looking to achieve by tokenizing right now?
Yeah, well, I think that comes down to the tools, and that's part of the reason why Galaxy was created, right? So if you create a suite of tools, then it more easily allows you to engage without having to try to take something out of thin air, in a sense, right? So for a creator, they're looking and saying, okay, I have this community, I want to engage with them. And what's been popular up to this point is effectively a rug pull. And I don't even know if these people have done it with poor intentions. I think, they just launched a token. People were extremely excited about it because obviously, hey, your favorite influencer or whatever, for whatever reason, is launching a token you want to support. And then you realize, oh no, there's no utility in this, or there's no tools to interact. So in the Galaxy ecosystem, you can almost think of Galaxy as the layer one of that utility, where you can have your own app that you don't even know Galaxy is the underpinning of it, right? A lot of times you look at any token right now in the space, Ethereum's the biggest layer one, right? So a lot of these ERC20s, et cetera, you don't really understand what Ethereum's doing behind it, nor do you necessarily need to. The same way Galaxy can have this social experience, this social feed. It can have these easy ways to DM, text, crypto, et cetera, and all these tools already built in. So when your app goes live and your token subscription model starts, you already have that built in. Right. That framework is already there for you. So now it basically makes it almost impossible to rug pull. The only way to rug pull in that sense would be to do absolutely nothing, and then you all already know the intention of said influencer, et cetera. So that's just a bad actor. That's not, a failure of the model. So that's what we've really done a lot of work to build, and we think will take off in the next 8 months.
Can't wait to check back in the future. Spencer, thanks so much for taking the time, and good luck the rest of the season as well.
Thank you, brother. Appreciate you.
Thanks. We want to turn now to a conversation around building wealth. According to a 2024 UBS report, the U.S. will have more than 25 million millionaires by 2028. And Ramsey Solutions is talking about a method that you can use to become a millionaire using just 7 baby steps here. So joining me now on set to discuss, we've got Rachel Cruz, Ramsey Solutions personal finance and budgeting expert and host of the Rachel Cruz Show. Rachel, great to have you in studio with us.
Thank you. Thanks for having me.
Let's dive right in here. I mean, the first 2 steps, they have to do with savings and debt. So break them down for us.
Sure. Well, the very first step is to get a $1,000 emergency fund. Now, some people, listening or watching may think, wait, what? Is that it? But 40% of Americans can't cover a $400 emergency in cash. So that starter fund of actually having cash is huge. So you can put that just in a high yield savings account. And then step 2 is actually getting out of consumer debt, and do that by listing all of your debts, smallest to largest, regardless of the interest rate, pay minimum payments on everything, and pay the smallest debt off first, because your income is your largest wealth building tool. In order to build wealth, your income is so huge in that. But when your income's going out 18 different directions and payments, you're making the banks rich and not yourself.
Right. After you've essentially paid down your debt here and you're thinking about your house, or minus your house at least, there are 3 steps that kind of spread your money out to different areas. Talk to us about that.
That's right. Well, step 3 is you're going to build up your starter emergency fund to 3 to 6 months of expenses. Again, having that cash liquid to be able to get to when you need it, but having that cash is so important. And then baby step 4 is funding 15% of your income into retirement specifically. So 401k, 403bs, Roth IRAs. And then baby step 5, if you have kids, start thinking about kids' college, 529s, ESAs, and start thinking about their future.
And we have the last 2 steps as well. Finally, getting to that mortgage and ending with wealth. Talk to us about those last 2 steps.
That's right. Step 6 is paying your house off early. And we find that people are doing this in around 9 to 11 years. And this is huge. When you don't have a mortgage payment, there's not only freedom from an emotional standpoint when you have no payments, but also a financial. And then baby step 7, when everything's paid off, you continue to build wealth and invest and be extremely generous.
We were just talking about this in the break before we began our segment. It's the holiday season. I just want to get your take on budgeting through this season and on gifts as well. Talk to us about your approach.
You know, it's really important, I think, to be proactive and to ahead of time say, hey, here's the amount of money we have to spend. You know, we're 2 weeks from Christmas right now, so it may be a little late in the game for 2024, but for 2025, it's the idea of not going into debt, finding margin when you can, but also setting healthy boundaries. I mean, people have really been struggling the last couple of years, and it continues to be expensive when you're going and buying things. So maybe that there is a conversation to yourself, maybe with your spouse if you're married, to say, hey, Christmas may look different this year, but we're actually going to put boundaries up and spend money we actually have versus going and borrowing money, because about 28% of Americans are still paying off debt from Christmas of 2023.
Interesting. Rachel, thanks so much for taking the time here with us today. Rachel is also the author of the new children's book. We have it here on set with us. New children's book, I'm Glad When I Can Share. There you see the book cover on your screen right now. Rachel, thanks for taking the time.
Thanks for having me.
Coming up, everyone, your Yahoo Finance Market Update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We are 2 hours
hours into the trading day, it is time for Yahoo Finance's Market Minute. Stocks are pushing higher today after the latest inflation report came in line with expectations. 3 trending headlines we are watching today. Shares of Alphabet hitting a 52-week high after unveiling its latest AI model, Gemini 2.0. The company also made news calling for the FTC to break up Microsoft's cloud deal with OpenAI, according to the information. United Health Group shares are under pressure. The Wall Street Journal reporting lawmakers are set to introduce a bipartisan bill that would force prescription drug middlemen to divest pharmacies that they own. That would cut off a major source of revenue for pharmacy benefit managers and their parent companies. And Stitch Fix shares rallying today after it exceeded Wall Street expectations in its most recent quarter, though the number of active clients still declined 18% year on year. That is your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
Fitness is a key priority for many Americans, especially young people. 56% of Gen Z say that fitness is a, quote, very high priority. That's compared with 40% of overall U.S. consumers. This is according to a survey conducted by McKinsey. With the rise of at-home options for workouts like Peloton, how are gyms and boutique classes competing for Americans' hard-earned dollars? We've got Evelyn Webster. She is the CEO of SoulCycle here with us in studio. Great to have you here. I mean, I understand that you just got got off of a ride earlier
did.
this morning as well.
I did.
So you've already got your workout in and closed your rings. I need to do the same a little bit later on. Just take us into the mindset of how you're operating SoulCycle through this consumer environment right now, where there is more discipline about some of those discretionary dollars, even if they are going into something as servicing as making sure that you are just getting your fitness in.
So we are seeing such enormous growth in our business, actually. And so, I mean, of course, we're still dealing with the after effect of the pandemic in many ways, where habits essentially fundamentally had changed. But as consumers are increasingly focused on wellness more broadly and really becoming much more sophisticated in terms of how they're thinking about wellness, it's not just about physically how I feel, it's also mentally and emotionally how am I feeling about my wellness overall. We're seeing this huge growth in the category, and definitely for SoulCycle in particular, it's all about community, and so people want that human connection again. So we're seeing a lot of growth in the category, even though consumers are changing the way that they're thinking about wellness more broadly.
We always say health is wealth. What are some of the top trends that you're seeing in wellness right now that you believe could drive 2025?
We're definitely seeing, I made this point earlier about consumers are getting much more sophisticated. They want data, data to support the assertions that organizations are making about why something is good for you physically, emotionally, mentally. And so they're increasingly looking for data. Of course, they have access to much more data now with wearables. I think that's going to continue. And the definition of wellness is going to get much, much broader. So, wellness was this buzzword that we were all using, but not to be corny, but it is a lifestyle. Wellness is now a lifestyle, and so it's a very active choice that consumers are making with their time, effort, and their disposable income.
How do you go about orchestrating the right pricing for wellness, knowing how consumers are prioritizing, but also knowing that consumers right now are trying to figure out, okay, I've got to spread these dollars over several different places, and we just got the CPI print this morning, which really ran down the list of where consumers are paying more and paying less. Where does fitness play into that, and how are you looking out into next year and saying, this is where our pricing also needs to be cognizant of the environment too?
It's a really great question, actually. And I think we are continuing to explore different economic models for SoulCycle to ensure that we are affordable and accessible to the consumers who are increasingly seeking fitness. It depends on how you choose to ride with SoulCycle. You can just pay as you go, no commitment, and that's one pricing model, or you can choose, I'm going to make a commitment, actually, I'm going to lean in. And we are seeing an increasing number of our riders who are more inclined to make a commitment, and as a consequence of that, they can drive the price down. And so they're getting smarter in terms of how they think about their wellness holistically. They're also getting smarter about what's the optimum way for me to invest in wellness, and am I prepared to make a commitment which will drive my price down.
How is the business doing for SoulCycle right now? It's not an update that we regularly get.
Yeah. Well, it's doing really, really great, actually. We're continuing to grow. Clearly, managing a business like SoulCycle, which is 90% in real life, at the height of the pandemic, that was not fun. But since kind of middle to late 2021, we've been seeing double-digit growth every year. And so what's really fascinating about our growth is it's not just riders that rode with us pre-pandemic who have returned to SoulCycle, some of them slightly more slowly than we may have expected, but it's the new riders who are joining the community. And so we're seeing a huge explosion amongst Gen Zs and young millennials who are realizing that actually the optimum wellness journey needs to be 50% strength and 50% cardio. There's definitely been a shift through the pandemic to more strength, less cardio. It needs to be 50-50. And so we're seeing younger consumers really gravitating to brands like SoulCycle.
Are there more modules that you see SoulCycle needing to add on, or optionality that you see SoulCycle needing to add on? I think about some of the growth in HIIT classes, some of the growth in the reformer Pilates machines. How do you look out into the different competitive elements that are out there in the landscape and say, you know what, we would be right to kick the tires or at least see what type of demand is there from our customers?
So that's a really excellent question. And we have tried different modalities. So we have what we call B studios at a couple of our studios, which means you can go into the cycling studio, you can ride 45, 60 minutes, whatever it is, and then go into B studios to do meditation, to do Pilates, to do strength, to do stretch. That is popular as an added value component of SoulCycle. What I think is more interesting is that as consumers lean into emotional and mental health, that's the soul in SoulCycle. So for me, I think there's a much bigger opportunity if we lean into the soul versus other fitness modalities. Other players do those very, very well.
Just lastly, while we have you, let's talk about you for a second too, because I mean, this is a different type of business than you were running previously in your career. You made quite the pivot here, and as we're even showing just part of your resume here on the screen, previously in media and now on the SoulCycle, the fitness and wellness, health and wellness industry here. What has that pivot been like for you? What advice would you give to other people who are trying to orchestrate a career pivot?
That's a really interesting question, one that I didn't expect. It was a pivot. I tell you what I experienced. I was very intentional about coming to SoulCycle. I love SoulCycle. It gave me and gives me personal joy. It was my sanctuary, the place that I went when I was working in media. It was the thing, that's why we were talking earlier about, I probably ride less now than I did before. What was interesting, so it was a very intentional move, but what was interesting is how people box you in. People define you by the thing that you have been doing for the last, for me, 30 years. So I was the media and entertainment person. And of course, I'm not defined by the industry that I worked in, I'm defined by the skills that I've got. And so any advice that I give to people when they're considering a pivot is be careful that you are able to very clearly articulate the skills that you have that are transferable to any industry or discipline that you might choose to work in, because other people will definitely try to define you by your CV, and that doesn't necessarily speak to the actual experience and impact that you can have. And I'm 4 years at SoulCycle, having had 30 years in media. I think, I'm a general manager, and I've been able to apply those principles to Soul in exactly the same way that I did in media very successfully, and anybody else can do it too.
Evelyn, next time we'll do this conversation from within a SoulCycle, maybe while we're riding or spinning.
I'm going to hold you to that.
Okay, all right.
I love
Evelyn Webster, who is the SoulCycle CEO. Thanks so much for taking the time with us.
My pleasure.
Everyone, we've got much more on wealth after the break. You're watching Yahoo Finance. A programming note for you on today's episode of Living Not So Fabulously. UBS Wealth Management Chief Economist Paul Donovan did not mince words when he explained how discrimination for the LGBTQ+ community erodes as economic strife rises. Take a listen.
Whenever we go through periods of economic upheaval like we are going through today, or what economists call the fourth industrial revolution, there is a natural tendency in a very unstable, insecure socioeconomic environment to look for somebody to blame. And because the LGBTQ+ community has gradually acquired some rights over the last few years, that makes them a very easy scapegoat to blame, and that's what we're seeing come through now in queer economics, frankly, that we have a target painted on our backs.
Catch more of that episode and Living Not So Fabulously every Wednesday at 12 p.m. Eastern Time on Yahoo Finance or wherever you get your podcasts. Well, the year's coming to an end, and the last thing you probably want to talk about during those holiday gatherings is money. In fact, a survey from US Bank found that more parents were comfortable talking about politics with their kids, who they voted for, than they were discussing finances here. Scott Ford, US Bank Wealth Management President, joins me now in studio to give his advice on how to start those tough conversations. Scott, great to have you here in studio with us.
Thank you for having me.
First and foremost here, what are some of the biggest anxieties that parents and kids have around money from what you're seeing right now?
Well, a couple things. I mean, I think the good news is more parents are having discussions about financial topics with their children in the current generation than their parents had with them. So, for example, I think something like 44% of parents today have discussions about finances, topics like investing in stocks and bonds and mutual funds and things like that, versus like 24% when they were growing up. So that's kind of the good news. The parents are having more conversations. The flip side of that is the kids in today's environment, younger people aren't necessarily looking to their parents for financial advice. Many of them are getting financial advice in, social media and the like. So
with that in mind, how do financial conversations now compare to previous generations as well?
It's interesting. There's a generational kind of difference. The older generations didn't really talk a lot about money. I know growing up in my household, I didn't dare ask my parents, about our finances and
how much you make, man?
Right, how much do you make? Why can't I get this toy for Christmas, right? That just was a taboo topic.
Yeah.
But today, it's a lot more open and a lot more transparent, so people are having more conversations about money, and it doesn't have the stigma it once did.
Yeah, no, if I had dared ask my parents how much they made, a shoe probably would have turned
right.
the corner. What are your top 3 tips for starting those conversations?
We recommend people start small. Like, one of the insights from the survey is a third of all Americans, in relationships have lied to their spouse or their partner about finances. So things like how much I have saved, how much debt I'm carrying. So there's this shame and guilt that underlies all this. There's a very emotional context around money and finances that people have a hard time getting around. So you don't want to start at, kind of tell me everything. I want to know, what your bank balance is, how much do you have invested. Start with smaller things like, hey, what did we spend on groceries this week? Or how much did that cost us? Or another good recommendation is, hey, let's agree that if we spend more than X, we're going to consult each other first before we do that.
That's really good. You also mentioned to try not to judge other people's choices and how they're spending as well. How can you make sure that that's brought up in a healthy way?
It really is an important thing, because think about it, if your finances aren't great to begin with, and we know that people are ashamed to talk about it, being judgmental certainly doesn't help. A good colleague of ours that does a lot of family coaching, Tom Thiegs, he works with high net worth and ultra high net worth families. He literally is a family coach. He kind of shared this thought that transparency is better than secrecy when it comes to it. But you're not going to encourage that kind of behavior if you're really judgmental. So kind of assume positive intent, accept people for where they are, and just, begin from a place of, hey, I want to help and I want our relationship to be better.
So as we're here in the holiday season, then we know that there's going to be a lot of spending taking place. What is the best spending tip that families can be talking about right now, and the advice that they can be sharing amongst one another too?
Well, first thing is kind of try to plan to have a budget.
Yeah.
You know, people kind of tend to go overboard in the holidays, and then you have that credit card hangover, you know, in January and February, and you could be paying for that stuff forever. So kind of like make a budget and decide, hey, this is what we have to spend, you know, on the holiday season, and we're not going to go above and beyond that. And again, if we're going to break this budget, let's talk about it first, so that, you know, there's not this perception of like, you didn't listen to me and you didn't hear me. One of the insights from the study also was the fact that, you know, for 25% of couples, they cited, you know, financial challenges as their biggest relationship challenge, right? So a lot of that begins with communication. So start to have the money talk and get on the same page, I think is really important.
Scott, great to have you here in studio with us. Thanks so much for the tips. Hopefully some families know how to begin the conversations now after checking out this conversation.
Thank you for having me.
Appreciate it. Everyone, let's do a final check of the markets here as we're approaching 12 noon Eastern time. There you're taking a look at the Dow Jones Industrial Average, finally getting right here and on the right side of the trade. It's flat, but just barely to the upside here. Compare that to where we started off the hour, negative. We did it again. We made it green. But anyway, the S&P 500, that's holding on to gains, up by about 0.8%. NASDAQ Composite, we're seeing that up by about 1.5% here. I'm just taking a quick look at some of the sectors on my screen as well, just checking out how we're faring among the 11 S&P 500 sectors on the day. As of right now, health bringing up the caboose, but communication services leading the pack. That's up by about 2.5% right now. That's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton. That comes up at 3 p.m. Eastern Time. They'll count you down to and through the market close.